First
Hi,
benefit of
this is
option
Vishal
Hi
is
Markand,
guys,
founder
knowledge.
of
welcome to
Markand's
Like
Library.
first
With
video
a small
on
amount
Zero to
of
Hero
capital,
Today,
you now
options
live
in
in
program.
this video,
And
I'm
Toronto.
going to
Means,
talk
I'm
as I
so
said,
about
you can
glad
go
that this is
options,
going to be the
the basics
base
of
of
options.
this
things like
program.
bucks.
If you
In
already
case you're
know
When
trading
you're
a
coming
options,
for
you're
unicorn,
trading
futures
there's
or
options,
an
futures
you can
options
even
options.
program
skip
like
this.
options
Limited
If you're
choice
masters,
beheld,
completely
right?
new
So
to
that
now
this
what
means
is
that
all
or you
options
don't know
about?
what is
Now, as I
options
mentioned in
and
the
how
earlier
is
video
options
about
and what is
is
called,
futures,
what is
I'll
called,
explain
then this is
is
the video.
completely
Now
everything
what
different
I'm
too.
going to
about
do
Now, let
right?
me
is
show you
that
that.
For
we have
example,
this
now
money
Now,
I
we
organization
have
discussed in the
program
a
last
big
and we
portfolio
handle
and
video
I
it with a
have
that
full-time team,
holding
derivatives
and
is
I
lot
have
made
many
up
like a
of
shares in
complete
futures as well as
video
cash.
library for them
And
for
market up
everything,
goes up
futures and
crazy,
techniques.
and I'm
So I'm
now
going to pick
fearing that
up
it can
those
crash
videos which
anytime,
are
or there's an
in depth,
event coming
complete
up
in
like a
depth
budget
about what is
or a
even
banking policy
again,
or any
it's not
major
part of the program,
announcement,
but even
right?
I'm adding
Like
like what is
election and all.
complete
And I
derivatives,
know
like
that
in
what
anything
is
can
options.
first
happen if
What
there's
is
a
futures. So I'll
news
options?
have
We
report
one
already
and
video on
understood
anything
what
futures,
is
goes
then I'll
futures,
down,
have
right?
and I'm
maybe a
going to
couple
lose
of
a
them
lot of
on
money,
options
then
basic. So
then I
what is
need
There
to
are two
futures,
hedge it,
parts.
right?
what
Or
are
I
the
have to sell
requirements,
something.
what is
But
It's
since
contract,
I'm
what is
called
holding those
margin, what
stocks
is
on a long-term
expiry, all
basis
that,
like equity
plus
and all,
what is
I don't want to
options, what is
exit them, but
call,
I
what
can
is put,
protect
what is
my
now.
risk
expiry, what
This
is
is
by
what
buying some
option
puts.
expiry,
in
then what
options
So
is
for
we have to
example,
buy
you're
premium,
or
already
sell
holding
intrinsic
call
stocks
value,
or
or
put
put.
time value,
Now, what do you
all
mean
in
by
the
this we will
market
call?
like
play
Call
one crore,
in
two
the
is
crores
next
is
couple
stocks.
of
something
videos.
like,
So
and you
I'm
know
going to
that
Something
attach
wrong
those
can go
videos
to a
in
very
this
simple
section
example
in
is
straight away
like,
from
so
uh,
you
my
can buy
a
library,
puts,
and you
lottery,
guys
right?
which
can
I
watch
just
A
it,
lottery
and
explained.
is
you
Now,
guys
if you
going to
buy
love
puts and
this
market
section.
goes
This is the
down, you can
basic.
buy
And
nifty
then
puts.
as
a
you know,
lottery is a
Market
you're
goes
thing
trading
down,
on
called
nifty will
video,
where
go
plus
down.
you
other
Your
elements, the
puts will
buy
make
buying and
money.
for
selling
say
and
So
all
when
that.
100
market
rupees
goes
or
down,
say
your stock
So
$10,
prices
and
want to
come
then
go
down.
through
you
You
have
lose
this
the
money
one,
on
chance
your
of
stocks
take
winning
notes,
and your
watch it
equity,
kind
again
of
and
but
again.
a
in
lakh
puts
or
It's
you
a
make
big
money. So that's like
better
a
best
hedge.
is
In
to
case if
just
you
put
don't
some
have your
options
capital,
It's
it's
like
like an
exercise
only
in your
amount
insurance
that
that
you
we
use
use.
is
Is
the
the
portfolio,
amount
amount
that
that
you
and
you
be
paid
pay
for
looking
that
at that
lottery.
how we
every
buy
single
100
Insurance
day
bucks or
policy.
and
200
see
bucks,
how it
That if something
works,
$1,000.
how
goes
it goes
wrong, we
up and
get
In a
down.
insurance
similar
money,
You get
right?
way,
feel of
The
it as
people
well.
who
So
don't
you
have
gradually get
that's
into
fine. That's the same thing. When you
small
buy
small
puts
trades. Like I
and you
would
have a
prefer to
portfolio
go
futures
with the
and
buy
you use your
trades right
hedge,
now
contract size
and
is
as
like an
new,
like 5
insurance,
to
and
8
then go
and
to
lakhs
the
that's a
sell
great
trades,
tool
because
for
selling
hedging the
options can be
portfolio.
slightly
Risk
tricky.
management tool, even with
Versus
your
buying
futures
options.
trade, I
Buying
can
options does
manage
not
to
have
trade
that much of a
options
risk. So in
just
case
with
if you
small
lose
cap of
money,
options.
very
But with
and
difficult.
very
remember
small
that no matter
capital,
what
as
the
good as
strategy,
50,000,
no
you
matter
can trade
what kind
enables
of
to
training
trade high
program you
price
get,
What does
market.
no
Now,
matter
high
option
what
price
mean?
market,
the
I
videos you
suppose,
watch,
like for
you
example,
are going to
Nifty is
I have
10,000
lose money,
and
and
Bank
that's
Nifty is
in some
25,000
ways,
current market
and that
price
will
of
be the lesson.
say
Don't
Reliance
say there
is
is
like
no
1,500,
strategy,
big
no
names,
setup,
right?
no
And markets
program,
going
no
to go
trading
up to
program
1,800. Now
guarantees
most
any
people
money.
But I don't
fear
have the
But I'm
taking big
saying
capital
that
to
stocks.
trade
Like even I had a fear
you
like
paid
futures or the
money to
so
learn
margin.
the
what happens
tools,
is if
you
you
have to
can't
pay
trade
some money
25,000
upfront
stock
to
or buy
understand the
enough
trading part
shares,
of it.
then you
Suppose
can
if you're
trade
part
off
of life,
3,000
so
bucks.
Now,
So
just
I
get in the
FD and
game
buy
with
more than
small
say
small
for the
trades.
same
Get
20, 30 shares of
it's
Reliance.
like
It's
you
easier to
get
trade
into
high price
you
market.
can't
So what I
learn
can do is I
swimming
can buy
and
an
without
can
option.
jumping
become
into
a
the
Now
water
option
regular
is
and
I can buy a
testing.
call.
source
Just
of
Call
can't
income.
is
be
you buy
watching
when you
videos
are
and reading
bullish
about
for
it without
strategies which
And
we have
put is
designed
when
in the
you
clarifying
last
buy
it.
when
couple
you
of
are
years.
very
We
Now
are
that
strong.
if you
amazed
know
at our
that
own
it's going to be
results. First talk
maybe
about the call was two
kind
weeks
of
results. Call is
positive
like
input
something
zone,
like,
it
for
might lose
example,
money,
in that
might
let's
as
look
well
at
lose
this
small money,
and making a hell lot of money
which
out of
is
it.
Current
not
market
so
So
much
price
of a
is
that's
that's
a
a
problem on
regular
the
$1,500.
source of
mindset,
income.
neither
Okay,
on the
that's
pocket
benefit
Of
of
Reliance.
that
options.
much money. So
Now, what
start
are the
And
basic,
I'm
essential
thinking
that it
very
will go
basic,
to?
basic
Few
keeping
things
it
which you
quantities,
here.
small, small
essential is the
quantities,
And I
call.
don't
and
have the
then
Then
money to
slowly, slowly
buy
you can
put
gradually
futures, or
get
I don't
into
have
the
money to
premium
buy
bigger
enough
numbers
number
again.
of
Just
shares.
it's
strike
a
price.
But
then
then there
after
is a
you get
risk
the
value,
expertise, it's all
time
about
value, implied
adding
volatility,
zeros
which
Like
is
is
trading
your
will
capital,
explain detail each
adding
of them so
zeros
that
to
you
your
get a good hang of
quantity,
it.
adding
Right?
zeros to
And we know
your
the lot size
profits,
of Reliance
and
is say
adding
500.
zeros to your
shares. For
happiness.
example, a
So
what I
and
think
on
is
that
I
note,
am
let's
betting
watch
on
the videos
Reliance.
on what is
Buyer
derivatives, what is
buying the
futures,
call. For
and
example,
what
I
the
gave you
options
that
straight away
option that
from my
current
line. Thank you
market
so
price
much.
my
Can
view is
we
right.
next video?
Suppose market goes from
9,000
here to
and
here.
I am expecting the
Now
market to
that
go up
20
to
rupees
10,000.
will
So
go
the
up.
10,000 call
And
I
how
can
much
buy for
risk
20
I'm taking?
rupees.
20
Now
into
what happens
500
is
is
from the
basically
current market
10,000
price,
Hi, this
rupees.
is
this
This
is
is
Vishal
the
the
current
Khan,
market price. And
founder
now
now
of
in
all
case
Khan
is very
if
Trading
I
near.
if
Institute.
Then I pay a
1600 is the
higher
And
price
price
and
on
it
welcome
that.
to
remains
this
for the rest
basic
of the
video
month, it
on
does not go
derivatives.
above
What is
above
futures
16,
and what is
17 or
options?
1800. It
Now,
just goes touches
as you
around
know that
1750 odd.
derivatives
Suppose my bet
was
is on
started
1800.
in the
which is
year
That
the
means what?
current
2000,
Slowly
market
this 20
price.
and
rupees will start
since
coming
then it
down.
has
I
picked
And
up
at
have
the
like
end
like
of the
anything, and
month, it
it's
will
the
be
major
30 days to go
so
for
my
major
risk
risk,
volume
erasure,
which
which is the
happens on
last day of
any
the month.
national stock
And
exchange
this
is
is like the
nowadays.
first day of the month.
So what is
If I'm
derivatives
buying a
basically?
call, but
Derivatives
my
is
potential
comprised of
target or
two things.
potential
One
reward
is
is
called
1600, this
for
Reliance can go
example,
to
futures,
and this
1800,
is
it can also go
1650,
to 2200,
right?
right?
And
Now
this call
2200
should be
means
expensive.
what I was betting was
Why?
1800, for which I paid 20 rupees.
Because one,
But now
there
I
are
am
30
right
days
by
to go.
400
Second, it
rupees.
is very
So
near
this
to
20
the current
rupees
market price.
will move
Compared
up
to, there is a
become
price
400
called
rupees
and one is
1800
called
into 500.
and this there are
options.
30 days. So
Calculate,
this will be
that's 2
cheap.
lakh
And
rupees.
this is called
right? Why?
Derivatives.
I'm betting on
So that
Reliance
is
to go
possible
to
in
1800
options,
from
right?
Sorry for
1600.
that.
You just
Right.
made an
It's 200
investment
to
of
gain
10,000.
30
So
days.
what we are going to
And
talk
what is
about
more,
is
you can make
Reliance
what
the
the
potential reward
futures
is
and
kind
options
of
are all about,
unlimited, where
and
you
that's
can make
a
1600,
major
right? So
way,
it's
a
easier.
good way
That
to
means
make
the
big
my
money in the
chances of
market,
making
provided
money
you have the right
is
risk
higher.
management strategy.
That's why the
Now, if
premium
you
of
are
that option will
new
also be
here,
higher about the call options
new
in
into
case
this
we are
trading and
trading.
all,
For
and if you
example,
ask
what
people
you
that
need
they
is,
should trade futures
first
in
of
the
all, you
market,
need to have
and
a
then
view
the
that
first
markets
answer
are
they will
going
give
up.
you is that
This
you
to
should never
second
trade
instance is
futures because you'll lose all your money.
even we know
You
that
know why?
futures work in
Why they
contracts.
say that?
In
Because
this 16
they didn't
currently
have a
like
risk
that, there is
management
1700,
strategy.
there's 17.
If you have
So
a
if I'm
correct
buying
risk
a current
management
month
strategy,
option,
which
which
we
is
cover in
August,
all of
these
our
are called
programs, like
different
if you
September
attend
month options.
ABCT,
That means
anybody can trade.
the
We give a
price
very
target
simple
strike
risk
price.
management
So
formula
has
for
to
the
reach
price
in
I'm
that
buying.
period.
If you're
And
following that
that
risk
does not
management
happen in
formula,
that period, then I don't
then
make
there is
this
no
month
way. Then future
expiration,
is the
right?
best
And
thing
what
to
is the
make
premium
money.
which you are paying for
Or in
20
fact,
rupees
if you
16
attend that
square,
Star Trader
and
program,
if I bet
then you know that
1800 for the next
we rate
25
our
days,
trades
I
based
have
on
a
3-star,
room for
5-star,
1600 to
7-star price.
1800. So
That
that's
means the
how
probability
that's
of
the
getting
premium
working
you
is
always
higher,
work.
and
20
also
rupees
the
is
risk
called the
management in the
similarly
price
will
reward
have
is higher.
a premium
So in
into the
that
lot
case, I should
size
definitely
is
be
your
trading
investment.
futures rather
Market
than
price is 1600. When you
equity,
invest
because the
10,000,
leverage money will
you
make
are
more money.
I'm buying
But in
in the
every
current month.
any
That
and
means
every
before
trade
the
setup
last
which we
Thursday
have
of this month,
discussed in
price is
our
reached
programs, or
1600 or
in any
1830
of the
days to go.
strategies
Then
which we
only
cover
this
in
option
Millionaire
will
program, there is a
expensive.
risk which is
Otherwise, this option will
predefined.
give you
And
a
once you
put,
know the
right?
predefined risk, then
And
there is
then
no way you
what
should be
I'm
trading
betting for,
futures only.
say
For I've been trading
1400
futures
plus,
only since
right?
last
It will be
7,
cheap.
8
That's
years
about
now.
call.
Cash I
And
trade, but it's
similarly, I
very
go into
easy.
derivatives,
Or I don't
then
drag and
or
in fact
each of
multiple
them,
trades
and
on
about
it, but
put
I
also.
only
Why
now
what
buy
is
only
put?
futures
Because the
chart.
distance to travel
And
between
futures
something
trading.
similar
So what
and
is
the
futures?
strike
Now,
price.
first of
Put
all,
is similar in terms of suppose
is
right now
basically
market, for example, if there are 30
exchange
days
has
left, and I think
identified
market price
currently there
reaching
are over
15 14 is very
120
easy. That means the
stocks
premium will be
in
usually I can
futures,
do a short
right? That
trade on
means
price
not all
reaching 1400 will be very
2,500 or
less
3,000
and the
stocks
time
on the
is
market
reached,
on
the
national
distance I don't have the
exchange
margin or I
are
don't have
there
the
on
premium
futures.
to trade
Less. Only
futures, right? So what I
220
do is
stocks are on
I
futures.
buy put,
And then
call and
secondly,
put.
these stocks
Say for
are all
example, it
big
might be
names like
30
Reliance
rupees.
and Tatas
Now
and
this how this
Marutis and
20 and
Hero
30 are
Hondas and
derived, I'll
State
come to
Banks
that.
and all those
Okay,
major
so 30
stocks
rupees is the
are
premium.
into futures.
Now,
And
how many
each
days do I
future
have
has
for
a
Reliance to go from
thing
1600
called
to
contract.
secured, right? You are not, this is technical terms, you don't need to understand this. This is the last
Now this is a
expiry
futures
is
contract
31st.
that you
That's
are
28th or
not buying
27th.
shares.
Now this
You are
is
just
what I
betting into
learned
a
in
contract
all the
which is
options, which
10
this price
and you
can
can
drop
get out of
here.
the contract
If it drops
whenever
there,
you
this
want.
30 will
So when you buy, say in this case,
the
the
market does
contract
not go in
size
your
is
direction. This is the
predefined,
beta
and the
it stays
contract
there
size
only. In fact,
design
goes
is
up,
that per
but you still lose only
stock,
30.
all 220 stocks will have
if there is a
will have to
for
be
every
traded
trade goes in
into
your favor and goes to
into a
14,
particular
and for every
size of
trade who is a
trade,
buyer,
which is
like
like,
one
for
buyer call, then
example,
somebody
the size
definitely
of
is
the
a
trade
seller,
will be
right?
somewhere
You make
around
more
4 or
and
5
somebody
lakhs.
less, you are a buyer
That
of a
means,
put, then
suppose for
side, then
example,
that
let's
seller.
take Reliance.
Can we again come back
So
to, you can have four types
RIL,
of 30 can become
Reliance,
60
and
and
the
sell,
price
become
of the
100
stock
call
is
and
right
put. You
now
can
under
only four types
1600,
of trades are there
and
in
the
options. So that
that's
means
the
now
price.
how do you gives you an opportunity to
And the
participate
contract
in this
size
open
right of
derivatives with a
Reliance
very
is
small
500
capital
shares.
and without
Now
much of
500
the risk.
into
And if you are
1600 is
right, you
equal
can
to
be
8
rewarded in a
lakhs.
big way.
Now
So
you
I
can't buy
explained you the
Reliance
normal
100,
call
200,
buy
300,
story
500.
about
You have to
how
buy
I
500
ended up doing
or
well, that
multiples
how
of
I'm
500.
buying.
So that
I'm
is
bullish on the
1,000,
market, right?
1,000,
If you know that
1,500.
options
These
are
are
being
multiples
there
of
since
500.
last, I'm bearish
Now
on the
what
market,
happens
15
is
years now. But
initially
then
when
when
the
I'm buying
contract
a
size is
call
designed, it is
and
at
I'm bullish on the
500.
market,
But
somebody is
then
selling the
price
call,
go up
right?
and down.
What
There
happens
has
is a
markets are
buyer and
going
sell
up
a
right
call
now.
few
That
years.
means
Like
the
so, if I'm
contract
buying
value,
a
which was
call at 20,
decided
will
at
not
5
show
lakhs,
somebody
have gone
selling
to
a call
8
at
lakhs
20
because
rupees.
market
So
went
I'm
down.
bullish
So
on the
now
terminology.
very
That guy is not
means
bullish.
every now and
This
then
is a
after 1
seller.
or 2 years,
And
the contract
and
sizes are
same way when I
revised
buy
a put.
Suppose
And
now
bearish on
Reliance
the
goes
most
to
people who are
2005
selling the
in
puts.
the
That means
market.
it's not
Even
bearish.
still
That
people
means the
lose
contract
money.
size
Retailers
to
don't
understand
know
this
this.
clearly.
So what
And the
when
professional
now
buy
a
a
small
call
person,
or
a
buy
small
put
trader
and
or
when to
retailers
buy.
cannot
Now,
trade
I
7
always
lakhs
knew
in
if
one. That's why
when
they
I
have to
saw this
read.
happening for the first time
Bring
on
it down back
10
to 5
rupee, or
lakhs.
for
This
example,
happens
I
once
just
in
what
2
this
years.
Assume that
option
all of
called
you
And even if market
are
crashes
stop
big
watch for
time and
watching
the
this
contract
video,
price
and you have done
size goes
multi-trade,
from
and
5 lakhs
you
to
have
2
at least
lakhs,
seen my
they
free
will again
videos on
increase the
RSI
contract.
on
days
YouTube,
of
So
right?
currently we
liquidation.
are
Now let
looking
me
at,
take
say,
a
in
Tata
the
Motors
bullish
should give
market,
a good
Suppose if
graph.
I'm
the
So
bullish on the
contract
this
market,
is
size
what
what
would
you
should
be
be
see
the
the
say
average?
RSI, and I
75
didn't
to
have
8
much
lakhs.
about
And
60 knowledge about
yes,
Tata Motors,
Now
right?
what you
must
have
So
be
if it is
the
noticed,
above
profit.
60, that means it is
this
high,
But I
five
still
still
racks
bought
going
one
up. So
call
I
and
are
buy
traded
because it's last
when
2
2
3
3
the
days
months.
of the
whole
So
month, the
there is
option
something
premiums
called
are
the
now if
running.
eddy
I'm
current.
bearish on the
And I
market, where
bought
would be the
like
RSI?
the
Right?
option
It
that
would be
was a
below
lot size
40.
of some
Next,
Below
4,000,
40 means it's
500,
going
and
down
the
sharp.
option
and
price
Above
was
50
some
means
far.
going up
50 paisa.
fast.
For
So I buy
example,
a
if we
call
are in
below
over
Because
40
strikes
means
the
going
going
price
on,
down.
then
I
the
was
current
trading
is
was on a
August.
put 400 and
Now the other thing is,
400,
if it
and the
resists
then
there
at
is
option I bought
60,
September.
was
what does it mean?
420.
Now, since
And
this
then
is
it
20
goes
rupees
to
and
range
there are only 3 days left,
If it's not
bullish,
if I have to
then I
trade
don't expect the market to
Reliance,
go up. Then the premium becomes very small. I don't expect the market to go up. That does not mean necessarily it will go down. I bought that some 50 just that it's the resistance. Resistance
buying
means
current
60
next month
resistance
means
shares.
August.
That is the time I'm
So
going
what
to
happens is I
sell
buy
4,000
and I can hold this stock
and if market
till
is
the
taking support on
end of the
40,
month, and
2,200 is
all
not
this
going down.
contract expires
Support on 40.
the
Remember, I
last
said 2,500 was my
Thursday
investor video.
Okay, go and check my
And
YouTube
in next
video on
3
of the
days,
month.
this
that
400
means
become
in this
400.
case, if
If
August
market
is the
says
last
I'm not
Thursday, what would be the
bearish,
last date of August?
that does not necessarily mean
now
that means my 50 paisa option
for being bullish,
which was bought at
especially now
420,
incidentally in this
and the
case,
market value is
31st
supposed to be
is the
right
last
and
date
going to be
last
right on
Thursday.
time paisa became
But it may
20.
be
As the days are
27th in
progressing,
case of
the
July.
option value
Right?
is going to decrease because
And
it's a monthly option.
so
And
that
if you say that
doesn't
market should
matter
go
what the
to
date
from
is, it's the last
1600 to
Thursday which
1800,
matters.
but and we
that's
bought an
500,
option
what we were
like a
looking
call
at, right?
in
So
this
what
month,
happens on last Thursday?
and it does not reach
Last Thursday on this
1800 in this
August
month, but
contract,
reaches after
was
2 months,
expired.
2,500. What happens
We
is
use
it
the
as
word
an
on
option
expired.
buy, you have lost
Suppose
this
you're
trade.
holding
Now
one
this
lot
I
of
can tell
Reliance,
you frankly
it's
that this
1,500.
was a fluke.
again maybe you have to buy
Right? I didn't know
It
much
expires
about
on
futures
17th
buy or a
on
cash
last
buy. You
Thursday.
can hold and
This
roll
thing
over.
happens
Done
in
so you're not
Chicago
losing
your
any
broker.
opportunity.
That
You'll
means
make
it
that
will
money in
expire at
2007. So in
1,700.
option, what is one
then I
thing
realized
required
that
is
and
that
you get
you have
100
to be a
rupees
buyer.
profit
A 20
on
paisa or a
the
50
quantity
paisa
which
stock
is
can go
you have
like
to make sure that the
500
markets
to
are
20
moving
rupees.
fast.
It's
You
like a
make
multi-bagger
50,000
in 2
fast,
days.
that means
as your
for
Right?
us,
profit.
You
what does
talk about
fast mean?
multi-baggers when you
Now,
buy a
to
stock
buy
and hold
this
on for 5 years and
500
10 call
shares
20 years,
of
you get
Reliance,
that
how much you have to
multi-bagger
pay?
effect.
You
Now,
have
if
to
they are
pay
And
between
here
40,
is an
60,
option which is
you
at
have to
50
pay, there is no
paisa
momentum
and which when
that
goes
means
up to
neither they are
20
fast,
rupees
neither they are
and
slow,
margin,
neither
what's
they
the
are
word?
fast on
Like
the
20
charts,
times my money
neither bullish
in
the
just 3
exhaust
days,
value.
then
So
there
if
is
I'm buying a
definitely good amount of
1,600
money can be
contract,
made in
seller
this.
of an
which is
option.
So I
500,
thought let's
so
learn this thing
1,600 is the
professionally.
price.
Okay,
Right?
and then
To
learn from
500
the. Do you
is
understand
the
this? So when I
is the
started
then
doing
you
contract
programs and
size or
attending
the
the
lot
programs in
size
2008, 9,
becomes
and
8
10,
lakhs.
hell
at
lot of
least
money out of
I would have
And
attended
into 20
so let's move
percent.
around
this
five,
is the
1
main
lakh
meaning of
60
it.
6 and
K
7
is
training
start you
programs
pay
and
Make
options
to
sure
buy
whether
one
you're
lot
bullish
of
or
Reliance.
bearish.
Now,
some of
once
the
you pay
best, not so bullish as
1,60,000
well
to
as
the
some of them
broker, you
abroad,
can buy
right? They're
500
taking
shares
their
of
online
Reliance.
courses.
Now, what is
One
strike
lot of
price?
Reliance, and you
Then
can
I
hold
got
as long as you
predetermined
want till the
price
last
at
Thursday
which
of the
the
month.
underlying option
Now, what
will be
happens
bought
is,
or
suppose you
sold.
bought at
So
1,600
different.
today.
Then
Now,
On the
predetermined,
7th
like
of
I
August,
explained you that
on
if
7th
you
of
know
August, it is
1600,
1,850,
1700,
1700
right?
rupees,
So if
1700,
you're making 50
1800,
rupees on
our
500 shares,
T4
every
which is
50
core
points,
value,
Bank
25,000.
Nifty
what
could
we
So
give you 100
every
points.
whenever
And if you take the
market is in
stock is
your
like
favor,
a small stock like 100
this is
rupees
what we
stock, then
do, so
every
that
5
a
rupees,
layman
which you have
can
not
100, 100,
booked yet,
500,
but
10,
every
100,
time there is
20.
a profit,
And then
we
if
have
a
already
very
made
small
it
added
stock
to
like
your
20
potential
rupees
to
stock
your
like
ledger.
something
So
like
suppose your
Arcor
ledger has 2
and
or
lakhs,
JP
since I
Associate,
have
then the
used
strike
this
prices will
simplicity
be
and
every
formula,
50
you
nothing
bought one lot
complicated
of
goes in
Reliance,
my
so
head and nothing
depending
comes out
your
on
of
the
my
1 lakh
size of the
60,000.
stock, the
so
strike price will
it
be
was a waste
different
That
from
from
different
7
stocks.
programs which I did.
They are
balance.
Paying around
pre-designed.
5.5
Now the
lakh
Reliance
rupees
stock
to
has gone
design
up
my
by
plus
50
the
rupees,
trial
so
and
you
error
need
method and plus
25,000.
all the stuff
So
which
that
I
25,000
traded
will
based
be
on
added.
those complicated stuff
Your 160 is your margin, which
I
will
can't even
remain with the
calculate.
broker till you
So
don't
what
exit,
happened in
right?
Then after
2011
it
and
goes to
12 and I thought
1700,
I gave up
You're
on all
making
this
another
and then
75,
finally
another
thought
50
that
rupees.
this is very
So another
important.
25,000 will
What
be
am I
added.
good at? So what is
And
my
then finally you
portfolio?
sell
Or
at
core
there are 3 types of
distinct
strike
your
price. One is called
I'm
in the
strong.
money,
So I
at
said,
the
okay, I'm
money,
good
and
at
out
So
the money.
160 will be added to this.
and call and put will be
good
different.
candlesticks.
Now
Right?
suppose for
Now
example
you're back
1600 is the
to
price,
like
50,000.
Bollinger Bands and stuff
okay,
like
basic
that.
stuff.
Now
That's
this
where
is
my
the same
simplicity
thing when
comes
you
in
do a
picture.
loss also.
Then
So
I said
as
if
long
I
as you're
have to
making
trade
money, that money
options,
comes to you
this
in your
call and
account.
put
And
using my
as soon as you
methods
lose
such as
money,
RSI,
suppose your
my
account goes from
trading methods,
1600, it
my
goes
money
to
flow program methods. How would I trade options without using those complicated
So how much you are
stuff?
losing?
So I started to design few strategies.
That means
I'm bullish.
500.
I started can buy a call call
testing
at
them.
1600 and also started forward testing them in the futures market.
Right?
Or I can
Your
buy
account
over
was showing 2 lakhs
16
paper trades.
sell
minus
1800.
Then I found
160
that some of them are working.
Or I
was
can
40K
even
was
buy
your balance.
1600
Now
and
your
repeat
50K is your
all
loss
those. This is a call
strategies
so
and
your
made it
account is
more
in minus
cost.
10K.
And I can
So
buy a
broker will call you and say
1500
you
call
have to pay
size, and
10,000 rupees.
then I saw that it is working well,
called as
and
mark
1400
to mark
options have become
loss
an
or
integral
mark
part
to
of my
market
trading.
profit.
Now,
my portfolios,
current
what I
market
manage,
price
and
is
also
this.
So in this case,
my-
you are
So
losing.
whichever is the
course
current
From your
market
point
price
to the
right now,
market
it's
price, you are
called
using
as
50,000,
program
so you have
of
to
the
pay
money.
that.
And this is
Now,
where
once
we
the price
design
comes
if they are
back
far
again,
away
some of the
from the
similar
current
you will
market
get
price
it.
without
But if it
using
can
any
keep going down,
complication that
you have to
can
keep
add
paying money to the
1600
broker.
using the
And
same
that's why
price
people
as
lose a
so
lot of
that's how
money
I
in this
expanded
because
out
they
on
don't have a
options
stock.
if they are not
Now,
currently
suppose
trading
you're
out
16
what the market
what
is
all
saying, then
benefits you
expecting
have
out
and you sold
as
something
far as
how
out
much
in the
money
options
you
are
make?
future.
concerned.
50,000.
That's called out
How
of the
much is
money.
your
Or if I'm
investment?
trading at the current market price, it's
1,60,000.
at the money.
So on
And if I'm trading an option
1,60,000,
which is
within few
below
days,
my
if the
current
stock
market
goes up
price,
by 100
that
rupees,
means this
which
is
is
already
from
factored
1600 to
into it. So
1700
this
is
will be
how
called
much?
as
6%.
in the money.
So market went up by, the stock went up by 6%,
So
but
in the
your
money, at
capital,
the
which was
money, out of
160
the money
invested,
for calls
plus 50,000,
is like this.
that's almost
Strike
a
prices.
30%
So
return.
either I decide now
Because
when do we buy this?
you
When
are
do we buy in the money?
leveraging
When do we
money,
buy at
because
the
you
money? When do
paid
we
just
buy out of the money?
20% of the
Depending
8
on
lakhs
what
and
is
you
your
bought
view.
stocks worth 8
If
lakhs.
I'm
So you are getting
expecting the
returns on
market
8
to go
lakhs
from
as well as your
1600
losses
to
are on 8 lakhs.
1650,
So that's
then
why
I
it
may
is
buy
kind
at the
of risky
money
if you
or
don't have
in
a
the
risk
money.
management
If
strategy.
I'm
And
expecting
one
the
day
market to go from
Reliance goes by 100
1600 to
rupees or 200
1800,
rupees in 2-3
1900,
days,
which is
your
a big
1.5
move,
lakh, 2
then
lakh
I'm
goes out of the
expecting
box.
I can buy
That's
out
why
of
it
the
is
money.
risky. But
This
once
is
you have
one
a stop
factor
loss,
to
then it's the
consider whether
best thing
in the
to
money,
do.
at the money, or out of
So
the
I
money. The
strongly
second factor
suggest
is
that if you want to trade
which part
futures,
of the
you
month
should be
I'm trading.
trading only with a
If
capital
I'm
which
trading
you
in the
have around
first
4 to
10
5
days,
lakhs.
first 10
That
days of
means
the
you
month,
can trade
let's
1 or 2
divide the
lots,
month
plus
into
you
30
can have
days,
some
including the working,
margin for
non-working days,
mark-to-market
30
losses
days.
in case
So
you incur
first
some
10 days
losses
of the month,
in the beginning. So
what we
that's
are going to
only way.
get
If you have
is
1 or 2
we are
lakhs,
going
you
to
should
trade
not
out
think
of the money.
about
Why?
trading
Because
futures
there are
right now.
many days for
Okay.
the market to perform.
Now,
So
as
why
we have margin
we
of
should not
20%
target for a bigger one?
on the
Because
stocks,
that's how,
but
that's
if
the
you trade
potential.
Nifty
So
or Bank
out of
Nifty,
the
the
money for
margin is
first
only
10 days,
10%,
at
because
the money
Nifty
for
and
next
Bank
10
Nifty,
days,
which are the
and in
indices,
the money for last 10
they
days.
don't fluctuate
So
that much
let's
compared
take
to the stock. So stocks
1
have
to 10,
20% and indices have
10 to
10%.
20,
So for example, if I am
and
trading,
20 to
I think the markets are going to go up,
30.
like it's going up. So I buy
Right?
one
So
lot
these
of
are two
Nifty. Now the
factors on
Nifty
which I
lot size
decide whether I
currently
want
is
to buy
75
in the
shares.
money, out
And
of the
that
money,
means, and
at the money.
10,000 is the
Got it?
price. That
And
means the
call is
contract
like
size is
simple.
7.5
Going
lakh
above
rupees,
the market price
right?
is out.
Sorry,
Going below the market
not
price is
7.5
in.
lakh rupees.
Now
It would
put will be
be
exactly opposite
almost
of this.
10,000 into 75. Yeah, 7.5 lakh rupees.
Let's
And then
take
10% of that margin
put.
you have to pay, which is
And this is
75,000.
1600.
So you can hold on as long as you want.
Current
Now
market
suppose,
price.
now I will teach you another concept.
Okay. So if I am
Is
having a put
you
here,
buy an August contract, which is the current
PA,
month. And
this
then
is
there's a
called
next
at
month,
the
which is
money.
September, and then the
Now
far
put
month,
I'm
which
bearish,
is
right?
October.
So if
Now,
I'm
as you
looking at
reach the
bearish,
last
which
Thursday
is
of the
say
month,
1500,
okay, and you think
or
that you still
1400,
want to hold on to
these are all
Reliance or
called out
Nifty
of
for
the
the next
money.
month as well,
And
then
if I'm
you have to
trading at
instruct your broker on the last Thursday that
1700,
roll over
1800, and these
my
are all
position.
called as
That
in
means
the
what
money.
he will do
This
is
ulta of
he will sell the
calls,
August
right?
contract,
Exactly opposite
and
of
buy
calls.
the
So when I'm short
September
and I'm
contract, and
wanting
then
the
there'll
market
be
to
a
go
small
down,
difference which
so
will
I'm looking
be
at
there.
market to go
Suppose
down
for
at
August
15,
is
14,
trading at
that means
1600,
out
then
of the
September
money.
will be
And
trading
if I'm
at
looking from, if
1602
the current
or
market
4,
price is
say 4.
1600,
So 4
and
rupees
I'm
you have
selling
paid
from
as a
I'm
premium.
buying a put which is
Why?
1700 or
Because now you are
1800,
getting to
that
hold
means
this
I'm
contract
already
for
in the
another
money by
30
100 or
days,
200 rupees.
another
Right?
25
So
days,
this will be
last Thursday of the
expensive.
September.
In the money is always
And as soon as
expensive.
August
At
contract
the money is
expires,
medium,
one more
and out
far
of the
month
money is
contract
cheap.
will start, which is
Right?
November. So now
Same
you have
options.
September,
If I have a
October,
big
November
view,
as
market
three
will crash
contracts.
big time,
And
then I
now
buy out of the
September
money,
becomes current,
or I buy at the money.
and
And
October
so
becomes
first
next,
10 days
and
out of the money,
November becomes
next
par.
10 days
Generally,
at the
in
money,
our market,
last 10 days
everybody
in the
trades
money.
current month
So this is
market,
how
current month
options
futures,
strike prices
right?
we are talking
Because
about,
that's
as well
where
as in the
maximum
money, out of the
liquidity
money
is
thing.
there. And as soon
Now
as
let
we
me
approach the
explain you
last
for you an
Thursday of the month,
example
we
on the
try to
screen.
roll over. You can even roll over
Right?
3 days
take
in
this
advance, 5
example.
days in advance, if you are sure that you are going to hold on for a long period of time.
See this, just observe this
Or you can
chart
hold
for a
on
while.
till the last Thursday
Now
and
look
then
at the
see whether
current
you
market
want to roll
price.
over or
It
you want to
says
let it expire.
7,900.
Right? So till the
Right?
transaction is not over, your margin is held
And
with
what
the
is
broker.
the
And
current
every
market
time
price?
mark to
That is
market
called as
profit is added
ATM,
to your
which is
account,
at the money.
and every time mark to
And if
market
it
loss
is
is
out of
subtracted
the
from your
above
account,
the
and
market
if your
price, which
account
is
is falling
8,000,
short of it,
8,200,
the
that's
broker
called
will give you a
OTM,
call.
out of the
And if
money.
you don't give
If it
the
is
funds,
below the
they will
market price
they will
that is
square
called
up,
in the
or
money,
they will sell your
ITM,
futures
ITM,
contract.
right?
So that's how this
Did you see that?
futures is
That's
very
for
simple to
calls, and
understand,
exactly
because it's basically
opposite
buying
would be
equity, but
puts.
only in bigger
Just have a look
quantities
at this.
with 20% margin, right? So, and what else? So there's one thing what we knew about futures is 220 stocks described assigned by the National Stock Exchange. Now how they
here
are
the current
selected and
market
why they are
price is
selected,
7,900.
that we don't need to get
right?
into, because
And
that's
if you
what
look
is
at
available and we should be
7,900,
trading
it's
them.
called ATM.
One.
And
Second,
if you
there
go
are 3
below,
months. current
7,900,
next
which is 7,800, 7,600. That's called
and
OTM.
generally we trade in the
If you
current.
go above, which is 8,000,
Last Thursday of the
8,200,
month is
it's called
expiry.
ITM.
Expiry means the contracts expire.
So this
And
is out
third
of
is
the money
rollover,
for puts.
going from 1 month
Now,
to the next month, which is
let's
like you
look
want to
at
hold
this.
on for more period of time. You can keep holding that
In
stock.
calls,
That's
strike price
that's futures.
is
Now, what is the
less than
advantage of
current
doing
market
futures?
price. It's
You know
called
that
in the money.
the biggest advantage of doing futures
In strike price
is
equal to current
what
market
we
price, it's
generally
called
trade,
at the money.
equity.
And
Equity
strike
trade
price
is
is
like
greater
this.
than
You
current
buy
market
here
price. It's called
and you
OTM,
sell here,
which is out of the money.
or you have
And
a
opposite
stop
of that
loss
will
here.
be input.
So
If
that's
strike
your
price is
buy.
greater than current market price, it's in the money.
You
If
sell,
strike price is equal to current
and
market
that's a
price,
stop
it's
loss,
at the money.
right?
And strike
This
price
is
is
a regular
less than current
transaction
market
in
price,
equity
it's called
also, and you
OTM.
can do in futures
Right?
also. And this is
Opposite of
called
each other.
as long trade. Means you are buying the stock.
Now, what is
you
a
are
premium?
bullish on the stock.
I already
You buy
gave you an
first and
example of
sell
that
later,
premium when I bought
right?
that call at 50
Now,
rupees into
what
that.
is the option?
So what is the premium?
What is the
Premium
thing you can do
price
with
of an
futures? You
option.
know, the biggest thing, the
remember,
best thing what I
options are
suggest or I
separately
like
traded
is that you sell first
instruments apart from
and
futures,
then buy later.
and each option
This
is
is your
traded
sell
with different, same way like any other stock. It's like buy price,
and
sell
buy.
price, quantity. Lot size is same as
And if it
futures. So
goes
if I have
up
to
to
buy
get a
one
stop
lot of
loss and
Reliance, it's
incur a
500
loss,
shares. If
stop
I have to
loss
buy
you
one
buy
call of
in case
Reliance,
you
it's
are wrong.
500.
And
And
this
if I have
is
to buy
known
one
as
put of Reliance,
short
it's 500.
trade.
So it's always the
Right?
same
Now,
lot
this is
size
the
as
biggest
futures,
advantage.
and
And for
options are same
us
lot
as a
size.
technical trader,
Now,
for us, market
options
goes up or
premium
market goes down,
is
we
generally
should be
made of
able to
two
make
things.
money.
One is called
Right?
the
So in
intrinsic
futures
value,
contract,
and one
there is an
called the
option
time value.
that you can sell
Right?
first
This
and then
is
buy later.
paid
Now,
by
you
the
don't
buyer
have
and
the shares
received by the
with you.
seller. So
So
if
in
I
equity, you need
buy
to have the
an
shares
option,
to sell.
I
Now,
pay the
in futures,
premium.
you don't need
For
to
example,
own the
let's give an
shares
example
before
here.
selling.
See,
It's
Nifty
just a
call is
contract
at
which you're
70
selling.
rupees.
Now, for
And the
example,
lot
if I
size
think
is
Nifty is going
75
to crash
shares.
from here,
So
say
total how much I
10,000,
have paid? 70 into
okay,
75.
I sell.
I have paid a premium of
lot
5250.
Nifty,
That's
which
my
is 75
investment.
shares. And
Now
it
that's the
crashes to
maximum I can
9,000.
lose in this game.
So I make 1,000
right?
points
And
into 75
but
shares.
if I go right, I can make
75,000
more
rupees.
than 10,
So
20,
that's where
20, 1
it is
lakh
very,
rupees
very
also, as I
useful. So
already
you can go
explained that.
short.
But if
and,
I
and
don't,
it's the
I
same way.
lose
You go to short today
5,250
and hold
because
out for
I'm
the
a buyer
last
of an
Thursday of
option.
the month.
Now,
And if you
when
think
I am a
markets
buyer
are
of an
crashing
option,
more in the coming
somebody
months,
is a
you can
seller
keep
of an
rolling
option.
over your
That
short
means if I'm a
position.
buyer of a call,
Right? So
that means
same
I'm
way,
bullish.
again, your
But the
margin
seller
is
of a
going to
call
be
is not bullish.
20% of
When
the
I say that I'm expecting
20% of
market
the
to go
stock.
to 1800,
So you pay again if you
for
think
which
that
I'm buying
Reliance
a
is going
call,
to go down
that means there's somebody
from
who thinks
1600 to
opposite of
1400,
me,
you
thinks
sell
that
one
market
contract
will not
for
go to
a margin of
1800, for which he's
1,20,000.
selling the
If
call.
market
Now,
goes
if
in
I'm
your
selling,
favor,
buying the call at
then you get
70
the mark-to-market
rupees and
profit in your
75 shares,
account.
I
And
have
if
to
market
pay
goes against you,
5,250,
then
and
it
he
will
will
be
receive
deducted. Now, if you
5,250.
sell at 10K
Now,
and if it
if
goes to
market goes
10,500,
up,
you
I
get a
make
stop
money
loss. So you
because my
lose
call
money.
will go up.
Now, this
But
is
if
where the
market goes
biggest
down, this
advantage
call will
comes,
become
as I
zero.
said, is
Right?
shorting
And
the
he's
market.
the seller of the
Now,
option.
if
That
you are
means
a
he
newbie
sold
in the
at
last
70
couple of
rupees
years, if you are
and
into
the
stock
option became
market,
zero.
then you
So
have
he
not seen
got
the
that
bear market
premium
yet.
too,
Now,
for
but I
him
have
to
seen,
keep
I've
it.
been there
Right?
since last 20
Now the
years. I've
difference
seen the
is when
bear
I
market
buy
of
option,
96, 95,
I have to
bear
pay a
market of
premium.
2000,
My
bear
risk
market
is
of
minimum
2006
and
and
limited,
2008,
and my
the biggest
potential
one.
reward is
And
bigger
2008 was the
because it can
biggest
go
turning
anywhere.
point of my
But
life
the seller of
because I
an
got it
option
right
is only
in
getting
that bear
this
market.
much.
And after that, there are
Right?
small
It's like
corrections, small
you buy
downtrends,
at
but
100
not a
rupees.
major bear market what we have seen.
Right? At the
So,
most, how
but
much
there
is
will
that
be
stake?
one because it's a
100 rupees.
cycle. It
But
goes
it will
up,
go
goes down.
and it can
So
go to
what
1,000
happens
rupees
is
also.
what we
But if
as
you are
technical
short,
traders
like you are selling
love
at
to do
100
is
rupees,
love to
what is
short
the
the market
maximum
whenever
benefit
there's
you
a
get?
downtrend
100
because
can become
market
zero.
typically goes in
Right?
this fashion.
So your
If you
profits
see
are
this,
limited, but the potential loss if it goes above
people,
is
the kids
unlimited.
play
Right?
slide and swing.
That's
So
where
this
the
is the
selling
slide
becomes
where they
more
go step
difficult
by
and
step
challenging
up,
if
and
you
then there
don't
is
know
a
how to do it.
slide like
Right?
this.
But believe
Right?
me,
So for
most
example, this
professional
takes 30
option
seconds
traders
to go up.
are
Right?
sellers.
And
They
this takes
just sell the
3
options
seconds to
and
come
make
down.
a lot of money, but they have a
For this
strategy.
3-second
And we also have
slide,
a
kids
strategy.
go up
So
all
don't
the
worry.
way top to
right?
make a 30
So
second,
selling, when to
30
sell an
second
option,
steps.
when to buy an option,
Exactly
it's
same
both
way
are
market
possible,
functions,
provided you know
because
the
when
right
market
strategy,
goes
the
up,
right setup,
they
the
go
right
like
view,
step by
which is
step, slow and steady.
bullish,
But
bearish,
when
not
market
bullish,
comes
not
down,
bearish,
it's like a
then you can
slide.
trade accordingly.
And there, if I'm short here and I buy here, I make lot of
Intrinsic
money.
value, it is the amount
and quick
by
money
which an option
and
contract
thick
is
money
in the money.
in shorts. So
Let me tell you
for
how
us,
it works.
bear
Let's
market,
take
bull market doesn't matter. Only thing,
intrinsic
if your
value
analysis is
at
right
the money,
and you have
out
the
of the
right
money
system
options
and the
do
right
not have any
method,
intrinsic value.
and your risk
So
management
intrinsic
is in
value,
place,
remember the
our
word
market, then we
intrinsic
should not worry
and
about
in the
anything.
money.
Then
only
us,
in
as
the
long as
money
markets
options
are open,
have intrinsic
our
value.
game is on and
Rest
we can
of
make
the
money.
options like out of the
So I
money
hope
and
that
at the
gives
money
you a
does
good
not have any
clue into
intrinsic
what
value.
is
They only
futures,
have one thing called
right?
as the
So futures
time value.
is a
Here I
lot
explained you
size,
that what is
contract
the
size,
premium. Premium is
and
made up of two things: intrinsic value
what do you say?
plus time
Rollover,
value, right?
margin, mark to market profit, mark to market
Now let's
loss.
look at time
You can
value.
go long, you can go
The part
short.
of an options premium
right?
over
Current,
and above its intrinsic value is
next
time
and
value.
far.
The
Generally, you trade
premium
in the
of
current
at the
month,
money and out of the
220
money
stocks
options
in
contract
futures
made up
only right
only
now.
time
They
value.
keep
Now
adding
let
some
me give you an
stocks and they
example
keep
here.
reducing
Look
some
at this
stocks
chart for a
depending on
minute.
some criteria, but that's not our concern. Whatever is available, you can trade. Indices, you have 10% margin. Stocks, you have 20% margin. You can hold for the rest for the rest of the month till last Thursday. If you still want to hold on, you can
Now
roll
look at
over the
this.
position and keep continuing with that.
Current market price,
right? So that's
is how
about
much?
futures trading, and it is the way. It
Current
is
market
traded on
price
National
is
Stock Exchange, so it's called NSE
7,900,
futures and options.
right? That's here.
Right, NSE derivatives.
And
right,
at
and
the money,
futures chart is
out of the
slightly
money is
different than
8,000,
cash chart. The
8,100.
difference between a
So if
cash
I'm
chart,
bullish
cash means
and I want to
equity
buy
chart,
options
and
worth
futures chart, the
8,000,
difference would be like 2, 3, 5 rupees.
see the value
maybe
of
half
the
a percent
premium
to
value
1%.
is around 30 rupees, 60
because
rupees.
they are
Why I
different
said
trade
that
instruments.
out the money
If you're
is
trading
always
futures,
cheapest,
as per
at
my
the money
view
is
and
medium,
observation,
and in the money
we
is
should only
always
look
expensive.
at futures
Why?
chart.
Let's see how.
Cash, then
why
you
are
look
we
at cash
paying
chart,
this 30 rupees?
right? And
right?
I think
We are
that's
just
a
paying
brief
this 30 rupees
video on
for the
on
time
futures.
which we are getting.
Now I will do
7,900
options in another
to
separate
reach
video,
8,100.
and we'll see you soon.
Right?
Thank you so much.
Further away from the
and,
price, that much
wait
lesser
for my next
the
video.
premium.
All the best.
So if it was
Thank you.
8,300, it would be like 10 rupees. Why? Because Nifty has to travel from 7,900 to 8,300 to make you money, which is rare case, which is less probability compared to the
in this
distance
video I'm
which
going
is
to talk
involved.
about
But
options,
for Nifty
the
to reach
basics of
7,000
options,
to
so that
800,000
in case
is
when you're coming
100
for
points.
futures
So
or
premium
an
is 60
options program
rupees.
like Options
But if
Mastery,
Nifty
it will
you
be
buy a
helpful.
call which is
Now, what
at
is
the
all
money,
options about?
right?
Now, as I
7,900.
mentioned in the earlier video
Suppose
about
Nifty
futures,
closes at
option
7,900
is
at the
completely
end of
different
the
tool. Now, let
expiry,
me show you
zero.
that.
Right?
Now,
so what
we
would be the
discussed in
value
the
of the
last
call?
video
Zero.
that
Why? Because you bought
derivatives is made
7,900
up
call
of
and market is 7,900. You paid 100 rupees for that.
futures
Now 100 rupees becomes zero.
and
But
options.
if you had bought 7,800 call, look at this now.
Again,
7,800 call,
that
whereas your
writing.
current market price is
And
already
now
7,900.
in options, what is options?
What do you
We
mean?
already
It
understood
means
what is
100 rupees
futures,
is an
right?
intrinsic
In
value.
options,
Means no matter what, if market closes at
there are two
7,900
parts.
at the
It's
last day of the month,
a call,
then also you will get
and
100
a
rupees back
put.
out of this 200 you have paid.
Right?
That means out of this 200,
Now,
100
this is
rupees
what
is intrinsic
in
and
options
100
we have to
rupees is
buy
time
or sell, call or
right?
put.
So as
Now, what do
you
you mean by
said,
call?
that only
Call
intrinsic
is
value
something
has,
like,
sorry, in the money options have
to give
intrinsic
you a
value.
very simple
Rest
example
all the
is
options will have only time value.
a lottery,
right?
A lottery is a thing.
Are you clear on this?
A
So
lottery
in the
is
money,
a thing called where
intrinsic
you
value. At the
buy
money, out of
for
the
say
money,
100
only
rupees
time
or
value.
say $10.
As time
and
goes
then
by,
you have the
suppose,
chance
or
of
let me give you
winning
an example. Okay,
kind of a
let's
lakh
do
or a
this.
million, right? But in case if you don't win, the only amount which you lose is the amount which you paid for that lottery, which is say $100
Alright.
or $200 or $1,000. In a similar way, people who don't have the margin
So
or the
let's take,
capital to trade
sorry,
futures, where because
Nifty
the contract size is like 5 to
current
8
market
lakhs, and
price
20% of that is
at
1,50,000 plus the risk reward is
10,000.
also
Okay,
sometimes
that
difficult
is
to trade
your
off futures with a small capital.
ATM.
But with very small capital, as good as 50,000,
Okay,
you can trade options.
and currently
what does
it is
option mean? When
around,
I
this is
suppose,
like 5th
for
of the
example,
month.
I have the current market price
5th.
of say
That means
say
we are, and
Reliance
the
is
expiry
1,600.
is
Okay,
on
and I think it is going to go up to 1,800.
29th
But I don't have the capital
of the
to
month.
trade.
That means you have around
the futures
24
or the
days,
margin and all that.
right?
And
This
with
is
that
the data
limited
which
capital,
is given.
I can't even buy
Now,
enough shares. Suppose
Nifty
if I have $50,000, so I could not buy more than say
9,800
shares of Reliance
call
at 1,600 price.
is
So what I
in
can
the
do
money.
is I can buy an option.
Why? Because it is
now,
below the
option is I
market
can buy a
price.
call. Call
That
is
means
you
there is
buy when
how
you
much
are
intrinsic
bullish,
value to this?
and put is when you
200.
buy when you are bearish.
Nifty.
So let's first talk about the call part.
10,000
call is like, for example, let's look at
is ATM.
Current market price is
and
1,600.
Nifty,
okay, of Reliance.
10,200 call
that it will go to 1,800.
is
And I
OTM.
don't have the money to buy
Right?
futures, or I don't have money
Let's
to buy
put a
enough
value
number
to
of
this
shares.
call.
But
That's
then there is a
minimum. This
1800
value should be
call,
more than 200. Why? Because there is an intrinsic
which
value
is trading at say
Let's put
20
it at
rupees.
270.
And we know
Right,
the
and
lot
let's
size
put
of
this
Reliance
value
is
at
say 500
90
shares.
rupees.
So what I
Or
think
you can
is
say
I am
70
betting
rupees.
on Reliance like a lottery.
And
I'm
let's
buying
put
the
this
call
value as
at 20 rupees. Okay.
30
And
rupees.
if my
Right.
view is right,
Now,
suppose
why
market goes from
we are
here to
paying
here.
270?
Now
You know,
that 20
200
rupees
is
will
the
go up.
intrinsic value, and 70
how much
rupees is
risk
the
I'm taking?
time
20
value.
into 500
Now, suppose as
is
time
basically
goes by, today is
10,000
5th,
rupees my investment.
and current market
Now, in
price
case
is 10,000.
if 1600 is the price and it
next
remains
5
for the
days,
rest of the
say,
month, it does
now
not go
we are
above 16,
let's
17 or
get this.
1800.
Now
It
we are
just
at
goes
10th.
touches around 1750 odd.
Sorry.
But my bet is on 1800. That
Now
means
10th
what?
means
Slowly
5
this
days have
20
gone
rupees
by.
will
That
start
means 5
coming
days have
down,
reduced from
and
the
at the end of the
expiry.
month it will become
Now
zero.
chances of
So
going
my
to 2000, 10,200 have
is
slightly reduced.
only 10,000
That means this will
rupees,
become 23.
right?
Three.
But my
This will
potential
become
target or
60
potential reward
or
is
50
that
rupees.
this Reliance can go to 1800,
And this will go
can
to
also go
250.
to
Why? Because 200 is your minimum
Right?
intrinsic
Now,
value.
2200
The current market
means
price is itself
what I
is
was betting was
10,000,
1800, for which I paid 20
will have
rupees.
200 value.
But now I'm
sure.
right by
So
400
as time
rupees.
goes by,
So this
you see that
20
time value
rupees
is getting reduced.
will move up
This is
to
time
become
value.
400 rupees.
Now as we go, say
into
we go to
500,
19th. Okay.
calculate. That's
Now
2
how many
lakh
days are
rupees.
left? 7 days or 8 days are left. This will become say
So
10
that
rupees.
is possible in
This will
options.
become
Like
30
you just
rupees.
made an
And this will
investment
be
of
still
10,000
230 rupees.
and
Right?
you can make,
And on
the
the
potential
last day,
reward
suppose
is
we are
kind
on
of
the
unlimited, where
expiry
you
day,
can make 1 lakh, 2 lakh,
29th
20,000,
of-
40,000,
of
70,000,
the month, which
or
is the
even
last day.
10 lakhs
Current market
in rare
price is
cases.
10,000.
But your risk
So
will
what would
always be
this
10,000.
option price?
So how's about that?
Hardly
That's
anything,
fantastic
saving
way
1
of
rupee,
trading.
because if
Now
it's
what
the end
you
of the
need is,
day, it will
first
be
of all,
zero.
you need to have a view
How much
that
will be
markets
this?
are going up.
This will also be zero.
And secondly,
Because 10,000 is what I was betting
even
for,
we
and
know that
10,000 what is
futures
it
work in
closed.
contracts.
So
There's
10,000
months,
call will only
current
have
month,
value when
next
market is
month
trading
and
above
farther.
10,000.
So if I'm buying
And
current
if
month
this
option,
will
which is
become,
August option or September,
this
any
was
month
0,
option, that means
and this
the
becomes
price
200.
target which I'm setting
Now you see that
has to
because
reach
there
in
is
that
no
period.
time left in the
If that
expiry,
does not
because we are
happen
on the
in that
last
period,
day of
then
the
I don't
month,
make this money.
there is no time
Right?
value
So
in
the
any
premium
of the
which you're
options.
paying
There is
for
only
20
intrinsic
rupees
value, and
is
intrinsic
the-
value is
is the
only
bet
in the
that
money
for
options.
the next 25
which is
days, I have a
9,800.
room
That's
for
200
1600 to
rupees.
1800.
And Nifty
Right?
call
That's the
10,000
premium
is
you're
0.
paying. This 20 rupees is called the premium price. And
So
premium
this is
into
how
the
it
lot
works.
size
Now
is
people
your investment, which is
who
10,000.
thought that market will
So
not
when you invest
move
10,000,
beyond
you
10,000
are in, and you are buying in
this
current
month,
that
they
means
would have
before the
sold
last
this option
Thursday
when
of
it was
this
around
month,
at 40
price should
rupees
reach 1800 or
50 rupees.
1800 plus.
And slowly it
Then
was
only
dragging
this
as
option
days
will make
by
money.
go by.
Otherwise,
It
this
becomes
option
40,
will become zero.
it becomes 30,
Right?
it becomes
Because
20,
your bet was
and then slowly it becomes zero.
for
So I
1800
sold
plus,
an option at
right?
50 rupees.
So that's about
and now
call.
it becomes zero. That means I've shorted
Similarly,
at
I go in
50,
detail
covered
about
at zero, I made 50
or
bucks.
each of them, and about put
Makes
also.
sense?
Now,
That
what
means
is
I'm
put?
not bullish on the market.
Put is
When
something
would I sell
similar,
a call? When I'm
right?
not
Put
bullish.
is similar in terms of,
Right?
suppose right
and if
now
I'm
market
bullish,
is
then I
1600,
buy a call,
and I
because
think
if this
market's going to
10,000 becomes
go to
10,400 or 500.
So
then
usually I
things
can
will
do
be
a short
different,
trade on
right?
futures.
Then market
right?
call will go up,
One contract,
and
two
I will
contract,
make
whatever the
money on
margin
my
is.
call, which
But I don't
bought
have
at
the
50
margin,
rupees
or I
can
don't have
become
the
200,
capital to
300,
trade
500,
futures.
right?
So what I do
So
is
that's
I
the
buy a
example of call.
1400 put. Say for example, it
Similarly,
might be
we'll
30
work on
rupees.
the put.
Now how this 20 and 30 are derived, I'll come
Right.
to that. Okay, so 30 rupees is the premium. Now, how many days do I have for
So we were
Reliance to
looking
go
at
from 1600 to 1400? Depends on
in
which
the
day
money,
you buy.
out of the money.
Suppose if it's
This
5th
was
of
the
the
thing.
month
Where
and
is
the
this?
last expiry is 31st or 28th or 27th, last Thursday of the month, that many days you have for which this price can drop here.
This is the
And if
one.
it drops there, then
So
this
this
30
was
will,
for the
rupees
calls.
will go up.
Now,
if the
intrinsic
market does
value
not
will
go
have
in your
always,
direction, which is down,
in the money options
and
will
stays
always
there
have
only, in
intrinsic
fact
value,
goes up,
and
but you
out
still
of
lose
the
only
money and at
30.
the money options will
That's your
always have
maximum
only
loss.
time value.
But
As
if
time
it goes
passes,
in your favor and it goes
the
to 1400
premium
and
will
1300
start
and
dropping.
1200 and
And
1100,
those who are seller of the option,
then
they will make
you
money.
make more and more
And those
more
who are
and
buyer
more
of the
money.
option, they lose
Right?
money
On
because
that 30 rupees,
time
it
is
can be
passing and
again
your
come
view is
back
not
to
coming enough,
30,
right?
30
But if
can become
market
60,
goes up
60
in
can
your
become
favor,
100,
then
200,
the
300,
premium will
400,
start going
depending
up,
how big the
and the
move
buyer
is.
will make money and the
So
seller
that
will
means
lose money,
that
right?
gives you an opportunity
Similarly
to
for
participate
puts.
in this
Now here
business,
it's
in this
exactly
derivatives
opposite.
with a
If
very small capital
7,900 is the
and
current
without
market price,
much of the risk.
then below
if
that
you are
will
right,
be out
you
of the
can be
money,
rewarded in
and
a
out of the
big
money
way.
means no intrinsic value.
Let me
only
tell you
time
the
value.
brief
Above
story
that, which
about
is 8,000
how
or
I landed up doing
8,100,
options
is
and
in the
how
money,
I learned options.
which is you
Now,
have an intrinsic
if you
value.
know
So
that
I'm ready to
options have
short.
been there since
Suppose market
last
is here,
15 years
7,900. I'm
17
already
years,
shorting from
2000 was the
8,000. That
time
means
when
there
it
is a
started.
100 rupee
And
intrinsic
then
value like
what
this.
happened is
And
till
200
a
if it is
few years, like
8,100.
2003, 4, 5,
Same way,
people were not so
we'll buy options.
good
First
with the
10
option
days of the
terminology
month
like
out of
call
money.
and put
Next
and
10 days of
premium
the
and
month
discount
at the
and
money, and last
and
10 days of the month
expiration
in the
and
money.
all that thing.
Right?
And
So
most
I
people
hope
were
if you
losing money
watch
in
this
the
video
in
a
the
few
market.
couple of
Even
times
still
at
people
least,
lose money.
and then
Retailers don't know how
go
to
and
trade
check
options.
option
And the
prices live
professionals
in the
make a hell
market.
lot of
What
money
are
in
the
the
live
market.
market? Take any
Now,
one stock
I
of
always
futures
knew
and options
when
like
I saw
Reliance
this
or
happening for
Nifty
the
or
first
Bank
time,
Nifty
a
or anything.
10 rupee
Put
option.
3-4 strike
I
prices
just
of
bought
calls
this
and 3-4
option
strike
called,
prices of puts,
there was a stock
and then
called
see
Tata
which are out
Motors.
of the
There's
money,
stock
which
still
are
a
in the
stock
money,
called
which
Tata
are
Motors,
at the money,
and I
and see
bought
how
that
market
option
moves and
in
how
the
option
last
prices
2-3
move,
days of
and
the
then you get a
expiration.
very fair
And I
idea
thought
about
Tata Motors
options.
should
And
give a
when you
good
come for
breakout.
options in the
I was
next
just using basic
class, you
technical.
can
I
be
didn't have
much
much
clearer.
knowledge about Tata
Now,
Motors,
how
much
is
knowledge
this
about
option
options.
price designed?
But I still
Means what
bought
is
one
the
call, and
5 components
because
of this
it's
option
last
price?
2-3 days of the month, the
One,
option
as
premiums
I
are
said,
very
the
small.
distance between
And I
current
bought
market
like
price and the strike price
option
decides the
that
option
was a
price,
lot
because
size of some
farther away the option price
4,500,
will be less.
and the option
Nearer
price
to
was
the
some
current
50
market
paisa.
price, option price will be more. Right?
Because
So one
the price
is
I
price
was
of the
trading was
underlying,
around
which is the futures
400
price. One is the
400,
strike price.
and the
One is the
option I bought
volatility
was
which is there in the market.
420.
One is the
Now,
expiry,
since this
means
is 20
how many days are
rupees, and
left
there are only 3
between
days
this.
left
As the days decrease, the
because
premium will
then
go
the
down.
premium becomes
Right?
very small, right?
And
It's very
short-term
less chances
interest
that
or
it will
rate
go
of
there in
dividend.
3
That
days.
means
So I
if
bought
the
that
same
some
money
50
was
paisa or
deployed
70
outside in
paisa,
FD,
and
what
one
kind of
lot
rate of
of
return I would have got?
4,500 shares. That means
6%,
my investment
7% currently.
is
Right?
4,500.
Now option prices
into
will
50
change as
paisa,
any of these things will change.
which is
So if
2,200 to
X
250.
number of
So
days
let's take
reduce, option price will
2,500.
reduce.
So
If volatility
2,500 was
increase,
my
option price will
investment. Okay.
increase. If
And
the strike
in
price
next
is
3
away,
days,
option price will
this
reduce.
400
If strike
become
price is near,
440.
option price will increase. If underlying means futures price keep going up, option price will
Okay.
become different.
Now that means my
So that's
50
where
paisa option,
these are the
which
5
was
major
bought at
components of
420, and the market value is
market or
440.
options,
That
which
means my
decides
50
the
paisa
option
became
price.
20
Right?
rupees.
Now we don't need to get into all these details.
And
we just
into
need to know when to buy
4,500.
and when to sell. Right? Now let me show you an example.
Let's take 20 into.
Let's go to our core forte,
4,500.
right? Core purpose,
Right?
and
That's
core
90,000
rupees,
rupees.
which is Nifty,
And
right?
the investment was
RSI.
2,500. Now, when I did this trade, now this I can tell you frankly that this was a fluke, right? I didn't know much about options. I just traded. When this thing happened in 2006 or in 2007,
now
look at then I realized that this is huge.
60.
A 20 paisa or a 50 paisa stock can go like to 20 rupees. It's like a multi-bagger in 2 days. Like you talk about multi-baggers when you buy a stock and hold on for 5 years
When
and 10
RSI
years and 20 years to get that multi-bagger effect.
See
and
how
here
market
is an
moved
option
up.
which is
So
at
if
50
I was
paisa
here,
and which
is
goes up to 20
130 rupees,
and I
would have bought an
like
option
20
of
times my money
out of the
just
money,
3 days,
and
then there is
goes up,
definitely
in
good
next
amount of
15
money
days
can be
goes
made
up,
in this.
then I would have made
So I
money
thought
on
let's
options,
learn this thing
right?
professionally.
2, 3,
Okay,
4
and
rupee
then
option
learn
would
from
have
the
become
best in
20
the
rupees.
business. So
Because
when I
RSI
started
is
doing
above 60,
programs and
bullish.
attending programs in
Now look
2008,
at this,
9
when
and
RSI
10,
is not
at
moving
least
above options,
I would have
60.
attended
What does this mean? I'm
around
not
5
bullish, right?
not
And
6
when I
and
sell a
7
call here,
training programs
I
and
call
options
sell calls
training
here,
with
and
one of
market
some
does
of the
not
best
move up
in India
as
as
the
well as
days
couple
are
of them
passing.
abroad.
See, this number of days
taking
are
their
going
online
sideways.
courses.
My option value will start dropping
Then
because
I
time
got into
value is
bigger trouble actually. Why?
dropping down.
Because it
So
was
I sell
so
option, I make
complicated
money
and
here.
so difficult.
This
and
was
so
a buy
different.
option.
Then,
this is a sell option, which is sell
then
call.
Because
Buy call,
if you know
sell
if,
call.
if you have
Now look
attended
at
any
this.
of our programs like ABCT or Star or
40
Millionaire or
support.
Money Flow, our core purpose.
Now below this,
value,
markets are not ready to go. So I know that from here, market will not bounce maybe, but I'm very sure this is a major support.
A layman
so I sell a put here because it does not go down. Put will start dropping value and I'll make money on the put side. So between 40-60, I'm looking to sell options because that's where where the time
complicated
pass is
goes in
going to
my head
happen,
and
and
nothing comes out
once
of
the
my
time passes,
mouth.
the
So
expiration comes shorter,
it was a
and the
waste
premium
of 6-7
gets
programs
lower.
which I did,
And if
paying
the
around
market are
5.5
highly
lakh
volatile, which
rupees
is
totally
fast,
on that,
that
plus
is why I
the
buy
trial
an
and
option.
error
This is a
method,
call
and plus
buy.
all the stuff
Now
which
let's
I
look at a put
traded
buy if
based
there
on
is
those
any.
complicated stuff
This is a put call
I'm
buy. Look at
going to
this.
calculate. So what
Above
happened
60,
in
call buy.
2011 and 12,
Bullish.
and I thought I gave up on all this,
Let's
and
look
then
at this.
finally thought that okay,
If it goes below 40,
what am I good at? So what is my
is a
core
put buy.
forte or
Why? Because it
core
is below
distinct
40,
forte where
and I
I'm
expect
strong.
the market to drop.
So I said, okay,
So
I'm
I'm
good
here,
at momentum
and I buy
indicators
out of the
like
money
RSI,
option
and I'm good
here.
at candlesticks. I'm good
Suppose
at,
this is
say,
80 rupees
volatility
strike price.
bands
This
and
is
like
70
Bollinger
rupees
Bands
strike
and
price.
stuff
Out
like
of the
basic
money,
stuff.
this will be
That's
cheaper.
where my
And
simplicity
then market
comes
actually
into
goes down to
Then I said, if I
60
had to
rupees
trade
or 55
options,
rupees,
this
so
call
my
and
1
put,
or 2 rupees
using
option
my
will become
methods, which is
15
RSI,
rupees.
which is
So
my
if my
star
view
trading
is right,
methods and
I make
my
money.
money flow
My
program
view is wrong,
methods,
I lose
how would
money
I
in the
trade
market,
options without
right?
using those complicated stuff? So I designed few strategies,
Right.
and
So
then
that's
I
brief
started
about
back
options,
testing them,
buying and selling.
also
Now
started
let me
forward
just
testing them
recap
in
what
the
all things
futures
did we
market,
learn.
in the
One
forward
is
market
options.
by
You have
doing
two
paper
things:
trades.
call and
And then
put.
I found that some
Right.
of them are working
And then
well, and
second
some of them
is
didn't
there is
work.
strike
So I
prices.
again
So depending
retweaked
on what
all
kind of
those
bullishness or
strategies
bearishness you
and made
see,
it more
that many strike price you can go up or down.
stronger
And in
and
strike prices, there
precise.
are three
And
things called at
then
the
I saw
money,
that
in
it
the
is
money,
working
out of
well.
the money.
And since
If
then,
price is
options have
near,
become an integral part of my trading, my
if price
portfolios,
is
what I
near
manage, and
the
some
current
and
market
also
price,
my
it's called at the money. If
major
price is
course
away
in one
from
of
the
our
current
programs
market
called
price in
Options
calls,
Mastery. It's a
it is called
two-day
out of the
program.
money, and below the market
This is
price,
where
it's
we
called in the
designed
money, and vice
some of the
versa
simplest
for
strategies
puts.
without using
Right?
any complication
Then
that you can even understand.
there is premium.
Using
Premium
the
is
same
made up of
RSI
two
and same
things. One
stuff.
is intrinsic
So
value.
that's how
One
I
is
landed
time
up
value.
on options. A
In
long
the money
journey.
options will
Now
always
let me
have
talk
intrinsic
about
value,
what
and
all benefits you have.
rest of the options
as
will
far
have
as
only
options are
time
concerned.
value.
First
You are
benefit
going
of
to do
option
four things,
is
which is let's do a recap
like you
of
with
this.
small amount of capital you can
you guys see
leverage a
this?
lot. Means, as I said, you can even start with $50,000 and $20,000,
Oh, were you able to
and you're
see
trading the
chart
same
when I did?
quantity as
No.
futures almost.
Okay, let me
with
do it one more
limited
time.
risk, right? So that's leverage. Second is you can hedge your portfolio.
this
Now,
is
what
the
do you mean
option.
by hedge? Is I'll
Now
explain
this is where
in
bearish
detail in one
markets
of our
are.
programs. But
When I'm a buyer of
for
a put,
example,
so if I
now
buy
I
here
have
put
a
out
big
of the money, I
portfolio,
make
and I'm
this
holding a
money
lot
in the
many
downward
shares in
market.
futures as well
And
as
let's
cash.
see when I'm
And market goes up crazy, and I'm now fearing
in
that
this
it can
sideways
crash anytime, or
market,
there's an event coming up like a
like
budget
here.
or a
See
banking
this
policy or
below
any
40,
major
above
announcement
60 not going.
like
So I'm
election and
not
all.
bullish,
And
not
I know
bearish.
that
This is where
anything
I
can
sell
happen if there's a
options,
news which is
right, and
negative,
make
and
money.
if it goes down,
This is where I buy
and I'm going to
options and
lose a
make
lot of
money,
money,
because buy
then
call, because that's where
then I need
strong
to
and
hedge
going
it, right? Or I
going
have to sell
fast.
something.
See, this is
But since I'm
sideways
holding
market.
those stocks on a
Sell
long-term
call
basis like
above
equity and all,
60.
I don't want to exit
60
them,
is a
but I can
resistance, 40 is a
protect
support.
my risk
Sell call, sell
by
put,
buying some
because
puts.
going sideways.
So, for example,
and
you're already
as the
holding
time
some
passes, I make
stocks
money when I sell an
in the
option.
market, like
And here
1
I buy
crore, 2
call
crore
and make money.
stocks.
So
And
this
you know
is
that
where
something
it
wrong
helps
can
in
go in the next few days
understanding from a
because of some
simple point
events,
of view whether
right?
you're
So you
bullish
can
or
buy
bearish.
puts,
You're not bullish,
which I
you're
just
not
explained
bearish.
you. When if you buy puts and market goes down, you can buy Nifty puts. So market goes down, Nifty
Let's
will go
do
down,
a recap.
and if your puts will make money. So when market goes down, your stock prices come
Benefits
down. You
of
lose money
option:
on
one
your
is
stocks
leverage,
and your equity.
portfolio
But in
hedge,
puts you
risk
make money, so
management
that's
tool,
like a
enables to
hedge.
trade high
So
price
you
market
protect
and
your
regular
capital.
source
It's
of
like an
income.
insurance against
What
an
is a
uncertain
call?
event,
Bullish
like how we
or
buy
not
insurance
bullish?
policies.
Put
That something
bearish
goes
or
wrong, we
not
get the
bearish?
insurance amount.
Premium
Right? Otherwise,
made
that
up of
insurance premium is
intrinsic
gone.
value, time
That's
value.
fine. That's
Strike
the same
price
thing when you buy
is
puts.
the price
When you
where
have
you
a
buy or
portfolio,
sell options
that means you are
depending on how
hedged
bullish or bearish
like
you
an
are.
insurance.
Time
So
value,
that's a great
intrinsic
tool
value,
for
and
hedging the
volatility.
portfolio.
Volatility is
Risk
how much
management
volatile
tool, even
markets
with your
are. Suppose
futures
when
trade,
there
you
is a
can
big
manage the
event
trades with
like a
manage your risk
budget or
with the help of
an
options by
election,
reducing the risk.
markets are highly
That we will
volatile.
see
The
in the
option
future
price
strategies.
shoot up, and when
Enables to
markets
trade
are
high
there's
price
no event,
market.
nothing
Now, high
coming
price
up, then the
market
option
means
price
something like
drop. So
Nifty
that
is
makes it.
10,000
Then
and
what
Bank
we
Nifty
saw
is
is a call.
25,000
Let's
and
go to the
Reliance
main
is
part of
1600.
this is the
And
main
stocks
metrics.
like big
You are a
names,
buyer of a call
right?
when you are
MRF
bullish.
is
When you are a
70,000.
buyer of a
Now,
put
most
when you are
people fear
bearish.
trading big stocks.
You are a
Like
seller of
even I
a
had
call
a
when
fear
you are
like
not
that.
bullish.
So
And you
what
are a
happens
seller of
is
a put
you
when you are
can't trade
not
25,000 stock
bearish.
or a 10,000
So let's
stock.
take
Then you can can trade
in
options.
RSI sense.
Now options
Buy
can be
call
as low as 20
RSI above
bucks for
60.
the same stock.
Buy
So
put
it becomes
RSI
easier to
below
trade
40.
high price markets.
Sell call
And it can
RSI
become a
resistance at
regular
60, not going
fantastic
up.
source of income.
Sell
And with
put
some
RSI
super
support at 40,
strategies
not
which we have
going
designed
down.
in the last
Make
couple of
sense?
years, we are
That's
amazed
the
at our
easiest
own
way to
results.
remember.
And our
Strike
students
price
results
is
especially, and some of
predetermined
them are
price by the
getting
market.
excellent at
Different strike
trading
price will
options
have different
and making a hell
at the
lot of
money,
money
in
out
the
of
money,
options.
out of the money.
So that's a regular source of income.
let's
So that's
recap.
benefits of options. Now, what are the essentials of
Calls,
options? Now, few
current
things which you
market price at the
essential is
money,
the call,
above
which
the
I
market
explained,
price is
put,
out of the money,
premium,
and below the market price is
strike price,
in the money.
intrinsic value,
Put,
time value,
current
implied
market price
volatility.
at the money,
Like this,
below the
I will
market
explain
price
in
is
detail
out of the
each of
money,
them so that you
above
get
the
a good
market
hang
price
of it.
is in the
Right.
money.
First is
and
a
that's
call.
the matrix.
For
Then
example,
we talk about
a call
premium,
is an
intrinsic
option
plus
to
time.
buy a security.
Intrinsic
A buyer obtains the right
is
to
only
purchase.
in
Now,
the
for
money.
example, I gave you that option that current market price can be
And time value is only at the
9,000,
money and out of the money
I'm
options.
expecting the market to go up to 10,000. So the 10,000 call,
So that's
I
where
can
it
buy for
makes
20 rupees.
calls
Now,
at the
what
money and
happens
out
is
of the money
from
only
the
time
current
value,
market price,
and in the
let's say
money
this is the
time
current
value
market
is
price, and
plus
my option
intrinsic
is
value
very near,
equals premium.
then I pay a higher
And
price
puts-
for that. Now, let me put it this way.
How in the money, at the money is only time value, out of the money is only time value, but in the money is time value
Suppose
plus
my
intrinsic
price
value.
is here, which is our current market price.
And major components
And
of the
I have
option
like
price is
30
price of
days to
underlying,
go for
strike price,
expiration,
implied
which is the last
volatility,
day of the month.
expiry,
And this is
short-term
like
rate
the
of
first day of
interest.
the month.
So this is
If
where
I'm
it
buying a
changes the
call,
option price
which is
depending on the
here,
market. Now I think this
say this
will
is
set you up
1600
with
for
basics
example,
of option,
and
and
this
I
is
said
1650,
that just go and check
right?
some of the
And this
option
call
prices in the
should be
market live
expensive.
and see
Why?
5 strike prices up, 5 strike
Because
prices
one,
down,
there are
and
30
then see
days
how
to
it
go.
behaves.
Second,
in
it
the
is
next
very
few
near
days,
to
and then you'll
the
get
current
used to.
market price.
Ideally, if
Compared
you are
to,
not used to
there is a
trading
price
option,
called
don't sell
1800.
options in the beginning because
And
that's
there are 30
risky
days,
in terms
so
of if you
this will
don't
be
know how to
cheap.
trade them. Ideally, you should be buyer of
Right?
an option where
Why?
the risk is very
I'm
limited
betting
to
on
the amount
Reliance
of
to go
premium
to
which you have paid.
1800
And
from
if it
1600.
doesn't
So
work out, that's the most
rupees in 30
maximum you
days.
can lose.
So what is
right?
more
So do
easier
some
for
paper
Reliance to
trades.
do
It's
from
just the
1600
basic,
to go to
just to get
1650 or
used to it.
1800? 1650,
Some of
right?
the most
So it's easier. That means
simple
my chances
strategies
of making money
which
on
I have
this is
designed in the
higher.
last
That's why the
so many
premium
years.
of that
It's
option
working
will also
fantastic,
be
and
higher.
people
The
are
call
making
option will be
crazy money.
expensive. So for example, it may be 100 rupees here,
Making a lot,
but it may
and
be
it's
30
very
rupees
simple.
here.
Like you don't need to
Why?
understand those
Because
Greeks. Now,
this
if
to
you
this
come across
distance
any
is
options
big,
book, you
right?
look at
This
something
is
called
one
as
way
Greeks
of
like
looking at
delta,
options.
gamma,
And
theta,
this
and all that.
1650 like
We don't
that, there is
even mention
1700,
that in
there's
our program,
1750,
so
then
that's not
1800 or
required.
1850. These are
Very
called
simple.
different
Simplicity is
strike
the key.
prices.
So I hope you enjoyed
Right?
this video.
This different
And see you
strike
soon at the
prices. So
next
what strike price I'm
video or the
buying,
next live
and
event.
what is the
Thank you.
number of days left in the expiration, and what is the current market price? So current market price is 1600 and strike price is 1800. That means it will be cheap because it is too far from the price. So that's how the call will work, right? And similarly, we'll have put. Say market price is 1600 and I am buying a put of 1550. So that is distance is this much, 30 days to go. This will be expensive. This is your put. And then if I'm betting for say 1400, it will be cheap. Say this would be say 100 rupees, then this would be say 25 rupees or 20 rupees. Why? Because the distance to travel between current market price and the strike price is the important thing, and how many days are left. So for example, if there are 30 days left, the price reaching 1550 is very easy. That means the premium will be expensive, right? And price reaching 1400 will be very less. The time is duration, the distance is big. That means the premium is less, right? Okay. So that's about put, call and put. Let's go back to, so that's premium. What is a put? Is a security. You're not, this is technical terms. You don't need to understand this, basically making things complicated. Now, let's see this. This is what I learned in all the options classes, and this makes absolutely no sense to me. And that's why I'm showing you now how I can replace this with a better metrics. Let me explain you that. That's very simple, right? See, for every trade, there's a call or a put, and therefore every trade who has a buyer, if you buy a call, then somebody definitely is a seller, right? So, and if you are a buyer of a put, then somebody definitely seller of a put. So you can have 4 types of trade. One is buy and sell, and one is call and put. So totally 4 types of trades are there in options. Now, how do you trade them? You will not trade them like this. Don't ever open any options book, and they will show you this only. Right? Let me put it in a simpler way. My job is to simplify, right? So I explained you the normal call, buy and put buys. When I buy a call, that means I'm bullish on the market, right? And if I'm buying a put, that means I'm bearish on the market. But then when I'm buying a call, and I'm bullish on the market, somebody is selling the call, right? There has to be a buyer and a seller together. So if I'm buying a call at 20 rupees and somebody is selling a call at 20 rupees, so I'm bullish on the market. That guy is not bullish on the market because he's a seller, right? And same way, when I buy a put, I'm bearish on the market, but somebody is selling the put. That means he is not bearish on the market. Now, if you understand this clearly, when to buy a call, when to buy a put, and when to sell a call and sell to put, things will become extremely easy. Now, for example, I assume that all of you are my students if you're watching this video and you have done my programs and you have at least seen my free videos on RSI on YouTube, right? Now let me make it simple. Suppose if I'm bullish on the market, what should be the RSI? Above 60? Yes, right? So if it is above 60, that means it is high speed going up. So I'll buy call. Let me put the whole matrix in place. Now if I'm bearish on the market, where would be the RSI? Right? It will be below 40. So below 40 means it's going down sharp. Above 60 means going up fast. So I buy a call. Below 40 means going down sharp, which is a put. Now, the other thing is, if it resists at 60, what does it mean? It is not bullish. It's a range shift, right? If it's not bullish, then I don't expect the market to go up. When I say it does not, I don't expect the market to go up, that does not mean necessarily it will go down, right? Just that it is a resistance. Resistance means 60 resistance. That is the time I'm going to sell a call, right? And if market is taking support on 40, that means it is not going down. Now support on 40, remember I said if you have attended the program, even in the video, go and check my YouTube video on RSI, that when it takes support on 40, market says I'm not bearish. That does not necessarily mean that I'm bullish, right? For being bullish, especially in option, you have to be right, and you have to be right on time, because as the days are progressing, the option value is going to decrease because it's a monthly option. And if you say that market should go to from 1600 to 1800, and you bought an option like a call in this month, and it does not reach 1800 in this month, but it reaches after 2 months, what happens is, if as an option buyer you have lost money, because this month option will go to 0. Again, maybe you have to buy next month. But if you are a futures buyer or a cash buyer, you can hold and roll over your position. So you are not losing any opportunity. You will make that money 200. So in option, what is one thing required is that you have to be a buyer. Whenever you are a buyer, you have to make sure that the markets are moving fast. If they are moving fast, that means for us, what does fast mean? Momentum. And momentum means above 60 call, below 40 put. Now if they are between 40 60, that means there is no momentum. That means neither they are fast, neither they are slow, neither they are fast on the downside. That means neither bullish nor bearish. And in both cases, we can be a seller of an option, which is sell call and sell put, right? So if you understand this clearly, then you can beat the market, beat the options, and make money, a hell lot of money out of options, right? Yeah. So let's move forward. This is the main matrix. Whenever you sit with your chart, just first make sure whether you're bullish or bearish, or whether you are not so bullish or not so bearish, right? Now, what are strike prices? It is predetermined price at which the underlying option will be bought or sold, right? Now, predetermined, like I explained you that thing, 1600, 1650, 1700, 1750, 1800, 1850. In Nifty, it will be every 50 points. In Bank Nifty, it will be every 100 points. And if the stock is like a small stock, like 100 rupee stock, then every 5 rupees, 100, 105, 110, 120. And then if the very small stock, like 20 rupee stock, like something like RCom or JP Associate, then the strike prices will be every 50 paisa or 25 paisa. So depending on the size of the stock, the strike price will be different from different stocks. They are pre-designed, right? Now pre-designed, like, see, these are different strike prices. Right? So these are all different examples. We can check them. Let's take, for example, now this is very important. Now, there are 3 types of strike prices. It's called in the money, at the money, and out of the money, right? And call and put will be different. Now suppose, for example, 1600 is the price. Okay, one second. Let me draw this. Suppose this is my 1600 CMP, current market price, right? If I have to buy a call, that means I'm bullish. I can buy a call at 1650, or I can buy a 1800, or I can even buy 1600 itself. This is a call, and I can buy a 1500 call also, and 1400 call also. Now, current market price is this. So whichever is the current market price, strike price, it is called as at the money, right? And if they are far away from the current market price, which is 1650 and 1800, this all are called as out of money. Means they are not currently trading near what the market is trading. I am expecting something out in the future. That's called out of the money. Or if I'm trading at the current market price, it's at the money. And if I'm trading an option which is below my current market price, that means this is already factored into it. So this will be called as in the money. So in the money, at the money, out of the money for calls is like this, strike prices. So either I decide now, when do we buy this? When do we buy in the money? When do we buy at the money? When do we buy out of the money? Depending on what is your view. If I'm expecting the market to go from 1600 to 1650, then I may buy at the money or in the money. If I'm expecting the market to go from 1600 to 1800, 1900, which is a big move, then I'm expecting I can buy out of the money. This is one factor to consider, whether in the money, at the money, or out of the money. The second factor is which part of the month I'm trading. If I'm trading in the first 10 days of the month, let's divide the month into 30 days, including the working, non-working days, 30 days. So first 10 days of the month, what we are going to get is we are going to trade out of the money. Why? Because there are many days for the market to perform. So why we should not target for a bigger one? Because that's the potential. So out of the money for first 10 days, at the money for next 10 days, and in the money for last 10 days. So let's take 1 to 10, 10 to 20, and 20 to 30, right? So these are two factors on which I decide whether I want to buy in the money, out of the money, at the money. Got it? And call is like simple. Going above the market price is out, going below the market price is in. Now put will be exactly opposite of this. Let's take put, and this is 1600 current market price. Okay, so if I am having a put here, PA, this is called at the money. Now put, I am bearish, right? So if I'm looking at bearish, which is say 1500 or 1400, these are all called out of the money. And if I'm trading at 1700, 1800, and these are all called as in the money. This is ulta of calls, right? Exactly opposite of calls. So when I'm short and I'm wanting the market to go down, so I'm looking at market to go down at 15s, 14, that means out of the money. And if I'm looking for, if the current market price is 1600 and I'm buying a put which is 1700 or 1800, that means I'm already in the money by 100 or 200 rupees, right? So this will be expensive. In the money is always expensive, at the money is medium, and out of money is cheap, right? Same options. If I have a big view, market will crash big time, then I buy out of the money or I buy at the money. And so first 10 days out of the money, next 10 days at the money, last 10 days in the money. So this is how options strike prices we are talking about, as well as in the money, out of the money thing. Now let me explain you through an example on the screen, right? Let's take this example. See this, just observe this chart for a while. Now look at the current market price. It says 7,900, right? And what is the current market price? That is called as ATM, which is at the money. And if it is above the market price, which is 8,000, 8,200, that's called OTM, out of the money. And if it is below the market price, that is called in the money, ITM, right? Did you see that? That's for calls, and exactly opposite would be puts. Just have a look at this. Now, here the current market price is 7,900, right? And if you look at 7,900, it's called ATM. And if you go below 7,900, which is 7,800, 7,600, that's called OTM. If you go above, which is 8,000, 8,200, it's called ITM, in the money, right? So this is in, at, out of the money for puts. Now, let's look at this. In calls, strike price is less than current market price. It's called in the money. In strike price equal to current market price, it's called at the money. And strike price is greater than current market price, it's called OTM, which is out of the money. And opposite of that will be input. If strike price is greater than current market price, it's in the money. If strike price is equal to current market price, it's at the money. And strike price is less than current market price, it's called OTM, right? Opposite of each other. Now, what is a premium? I already gave you an example of that premium when I bought that call at 50 rupees into that. So what is a premium? Premium is the price of an option. Options, remember, options are separately traded instruments apart from futures. And each option is traded with different, same way like any other stock. It's like buy price, sell price, quantity. Lot size is same as futures. So if I have to buy one lot of Reliance, it's 500 shares. If I have to buy one call of Reliance, it's 500. And if I have to buy one put of Reliance, it's 500. So it's always the same lot size as futures, and options are same lot size. Now, options premium is generally made of two things. One is called the intrinsic value and one is called the time value, right? This is paid by the buyer and received by the seller. So if I buy an option, I pay the premium. For example, let's give an example here. See, Nifty call is at 70 rupees and the lot size is 75 shares. So total, how much I have paid? 70 into 75. I have paid a premium of 5250. That's my investment. Now that's the maximum I can lose in this game, right? But if I go right, I can make more than 10, 20, 1 lakh rupees also, as I already explained that. But if I don't, I lose 5,250 because I'm a buyer of an option. Now, when I am a buyer of an option, somebody is a seller of an option. That means if I'm a buyer of a call, that means I'm bullish, but the seller of a call is not bullish. When I say that I'm expecting market to go to 1800, for which I'm buying a call, that means there's somebody who thinks opposite of me, thinks that market will not go to 1800, for which he's selling the call. Now, if I'm buying the call at 70 rupees and 75 shares, I have to pay 5,250 and he will receive 5,250. Now, if market goes up, I make money because my call will go up. But if market goes down, this call will become zero, right? And he's the seller of the option. That means he sold at 70 rupees and the option became zero. So he got that premium for him to keep it, right? Now the difference is when I buy option, I have to pay a premium. My risk is minimum and limited, and my potential reward is bigger because it can go anywhere. But the seller of an option is only getting this much, right? It's like you buy at 100 rupees, right? At the most, how much is that stake? 100 rupees. But it will go, and it can go to 1,000 rupees also. But if you are short, like you are selling at 100 rupees, what is the maximum benefit you get? 100 can become zero, right? So your profits are limited, but the potential loss, if it goes above, is unlimited, right?
That's where the selling becomes more difficult and challenging if you don't know how to do it, right? But believe me, most professional option traders are sellers. They just sell the options and make a lot of money, but they have a strategy, and we also have a strategy. So don't worry, right? So selling, when to sell an option, when to buy an option, it's both are possible provided you know the right strategy, right setup, you have the right view, which is bullish, bearish, not bearish, and then you can trade accordingly. Intrinsic value, it is the amount by which an option contract is in the money. Let me tell you how it works. Let's take intrinsic value. At the money, out of the money options do not have any intrinsic value. So intrinsic value, remember the word intrinsic and in the money. Only in the money options have intrinsic value. Rest of the options like out of the money and at the money does not have any intrinsic value. They only have one thing called as the time value. Here I explain you that what is a premium. Premium is made up of two things, intrinsic value plus time value, right? Now let's look at time value. The part of an options premium over and above its intrinsic value is time value. The premium of at the money and out of the money options contract made up only time value. Now let me give you an example here. Look at this chart for a minute. Now look at this. Current market price is how much? Sorry. Current market price is 7,900, right? That's here. And at the money, out of the money is 8,100. So if I'm bullish and I want to buy options worth 8,100, see the value of the premium value is around 30 rupees, 60 rupees. Why? I said that out the money is always cheaper, at the money is medium, and in the money is always expensive. Why? Let's see how. Why are we paying this 30 rupees, right? We are just paying this 30 rupees for the time which we are getting to for 7,900 to reach 8,100, right? Further away from the price, that much lesser the premium. So if it was 8,300, it would be like 10 rupees. Why? Because Nifty has to travel from 7,900 to 8,300 to make you money, which is rare case, which is less probability compared to the distance which is involved. But for Nifty to reach 7,000 to 8,000 is 100 points. So premium is 60 rupees. But if Nifty you buy a call which is at the money, right, 7,900. Suppose Nifty closes at 7,900 at the end of the expiry, 0, right? So what would be the value of the call? 0. Why? Because you bought 7,900 call and market is 7,900. You paid 100 rupees for that. Now 100 rupees becomes 0. But if you had bought 7,800 call, look at this now. 7,800 call, whereas your current market price is already 7,900. What do you mean? Means 100 rupees is an intrinsic value. Means no matter what, if market closes at 7,900 at the last day of the month, then also you will get 100 rupees back out of this 200 you have paid. That means out of this 200, 100 rupees is intrinsic and 100 rupees is time value, right? So as you said that only intrinsic value has, in the money options have intrinsic value. Rest all the options will have only time value, right? Are we clear on this? So in the money, intrinsic value. At the money, out of the money, only time value. As time goes by, suppose let me give you an example, okay? Let's do this. All right. Okay, so let's take, Nifty is current market price at 10,000. Okay, that is your ATM. Okay, and currently it is around, this is like 5th of the month.
5th. That means we are, and the expiry is on 29th of the month. That means you have around 24 days, right? This is the data which is given. Now Nifty 9,800 call is in the money. Why? Because it is below the market price. That means there is how much intrinsic value to this? 200 rupees. Nifty 10,000 call is ATM, and Nifty 10,200 call is OTM, right? Let's put a value to this call. Let's minimum, this value should be more than 200. Why? Because there is an intrinsic value. Let's put it at 270, right? And let's put this value at 90 rupees, or you can say 70 rupees. And let's put this value as 30 rupees, right? Now why we are paying 270? 200 is the intrinsic value and 70 rupees is the time value. Now suppose as time goes by, today is 5th and current market price is 10,000, and in the next 5 days, say now we are at, let's get this, now we are at 10th, sorry. Now 10th means 5 days have gone by. That means 5 days have reduced from the expiry. Now chances of going to 10,200 have slightly reduced. That means this will become 23. This will become 60 or 50 rupees. And this will go to 250. Why? Because 200 is your minimum intrinsic value, because the current market price itself is 10,000. So 9,800 call will have 200 value for sure. So as time goes by, you see that time value is getting reduced. This is time value. Now as we go, say we go to 19th, okay. Now how many days are left? 7 days or 8 days are left. This will become, say, 10 rupees. This will become 30 rupees, and this will be still 230 rupees, right? And on the last day, suppose we are on the expiry day, 29th of the month, which is the last day. Current market price is 10,000. So what would be this option price? Hardly anything, say 1 rupee, because if it's the end of the day, it will be 0. How much will be this? This will also be 0, because 10,000 is what I was betting for, and 10,000 is what is it closed. So 10,000 call will only have value when market is trading above 10,000. And if this will become, sorry, this was 0 and this becomes 200. Now you see that because there is no time left in the expiry, because we are on the last day of the month, there is no time value in any of the options. There's only intrinsic value, and intrinsic value is only with in the money options, which is 9,800. That's 200 rupees. And Nifty call 10,000 is 0. 10,200 is 0. So this is how it works. Now people who thought that market will not move beyond 10,000 in this month, they would have sold this option when it was around at 40 rupees or 50 rupees. And slowly it was dragging. As days go by, it becomes 40, it becomes 30, it becomes 20, and then slowly it becomes 0. So I sold an option at 50 rupees and now it becomes 0. That means I've shorted at 50, covered at 0, I made 50 bucks. Right? Makes sense? That means I'm not bullish on the market. When would I sell a call? When I'm not bullish, right? And if I'm bullish, then I buy a call, because if this 10,000 becomes 10,400 or 500, then things will be different, right? Then market call will go up, and I will make money on my call, which I bought at 50 rupees can become 200, 300, 500, right? So that's the example of call. Similarly, we'll work on the put, right? So we were looking at in the money, out of the money. This was the thing. Where was this?
This is the one. So this was for the calls. Now intrinsic value will have always in the money options will always have intrinsic value, and out of the money and at the money options will always have only time value. As time passes, the premium will start dropping, and those who are seller of the option, they will make money, and those who are buyer of the option, they lose money because time is passing and your view is not coming up, right? But if market goes up in your favor, then the premium will start going up and the buyer will make money and the seller will lose money, right? Similarly for puts. Now here it's exactly opposite. If 7,900 is the current market price, then below that will be out of the money, and out of the money means no intrinsic value, only time value. Above that, which is 8,000 or 8,100, is in the money, which is you have an intrinsic value. If I'm ready to short, suppose market is here, 7,900. I'm already shorting from 8,000. That means there is an 100 rupee intrinsic value like this, and 200 if it is 8,100. Same way, we'll buy options first 10 days of the month out of money, next 10 days of the month at the money, and last 10 days of the month in the money, right? So I hope if you watch this video couple of times at least, and then go and check option prices live in the market. What are the live market? Take any one stock of futures and options like Reliance or Nifty or Bank Nifty or anything. Put 3-4 strike prices of calls and 3-4 strike prices of puts, and then see which are out of the money, which are in the money, which are at the money, and see how market moves and how option prices move, and then you'll get a very fair idea about options. And when you come for options in the next class, it will be much clearer, right? Now, how is this option price designed? Means what is the 5 components of this option price? One, as I said, the distance between current market price and the strike price decides the option price, because farther away the option price will be less. Nearer to the current market price, option price will be more, right? So one is price of the underlying, which is the futures price. One is the strike price. One is the volatility which is there in the market. One is the expiry, means how many days are left between this. As the days decrease, the premium will go down, right? And short-term interest or rate of dividend, means if the same money was deployed outside in FD, what kind of rate of return I would have got? 6%, 7% currently, right? Now option prices will change as any of these things will change. So if number of days reduce, option price will reduce. If volatility increase, the option price will increase. If the strike price is away, option price will reduce. If strike price is near, option price will increase. If underlying, means futures price keep going up, option price will become different, right? So that's where these are the 5 major components of market or options which decides the option price, right? Now we don't need to get into all these details. You just need to know when to buy and when to sell, right? Now let me show you an example. Let's go to our core forte, right? Core purpose, core strength in market, which is Nifty, right? Or which is RSI. Now look at this. Okay, let's put it. Now look at this when RSI crossed 60. Okay, let me put it this way. When RSI crossed 60 here, see how market moved up. So if I was here, which is say 130 rupees, and I would have bought an option of 140 rupees out of the money, and then market goes up in next 15 days goes up, then I would have made money on options, right? My 2, 3, 4 rupee option would have become 20 rupees because RSI is above 60, bullish. Now look at this when RSI is not moving above option 60. What does this mean? I'm not bullish, right? And when I sell a call here, I sell calls here, and market does not move up as the days are passing. See, this number of days are going sideways. My option value will start dropping because time value is dropping down. So I sell an option, I make money here. This was a buy option. This is a sell option, which is sell call, buy call, sell call. Now look at this. 40 support. Now below this, markets are not ready to go. So I know that from here market will not bounce maybe, but I'm very sure this is a major support. So I sell a put here because it does not go down, put will start dropping value and I'll make money on the put side. So between 40, 60, I'm looking to sell options because that's where the time pass is going to happen. And once the time passes, the expiration comes shorter and the premium gets lower. And if the market are highly volatile, which is fast, that is the time I buy an option. This is a call buy. Now let's look at a put buy if there is any. This is a put call buy. Look at this. Above 60, call buy, bullish. And let's look at this. If it goes below 40 here, this is a put buy. Why? Because it is below 40 and I expect the market to drop. So I'm here and I buy out of the money option here. Suppose this is 80 rupees strike price. This is 70 rupees strike price. Out of the money, this will be cheaper. And then market actually goes down to 60 rupees or 55 rupees. So my 1 or 2 rupees option will become 15 rupees. So if my view is right, I make money. My view is wrong, I lose money in the market, right? Right, so that's brief about options, buying and selling. Now let me just recap what all things did we learn. One is options, you have two things, call and put, right? And then second is there is strike prices. So depending on what kind of bullishness or bearishness you see, that many strike price you can go up or down. And in strike prices, there are three things called at the money, in the money, out of the money. If price is near the current market price, it's called at the money. If price is away from the current market price in calls, it is called out of the money. And below the market price, it's called in the money. And vice versa for puts, right? Then there is premium. Premium is made up of two things. One is intrinsic value, one is time value. In the money options will always have intrinsic value and rest of the options will have only time value. You are going to do four things, which is, let's do a recap of this. Can you guys see this? Or were you able to see the chart when I did? No. Okay, let me do it one more time. See, this is the option. Now this is where bearish markets are when I'm a buyer of a put. So if I buy here put out of the money, I make this money in the downward market. And let's see when I'm in this sideways market, like here, see this below 40, above 60 not going. So I'm not bullish, not bearish. This is where I sell options, right? Then make money. This is where I buy options and make money because buy call, because that's where strong and going fast. See, this is sideways market, sell call above 60. Sorry, 60 is a resistance, 40 is a support. Sell call, sell put because going sideways. And as the time passes, I make money when I sell an option. And here I buy call and make money. So this is where it helps in understanding from a simple point of view whether you're bullish or bearish. You're not bullish, you're not bearish. Let's do a recap. Benefits of option. One is leverage, portfolio hedge, risk management tool, enables to trade high price market and regular source of income. What is a call? Bullish or not bullish. Put, bearish or not bearish. Premium, made up of intrinsic value, time value. Strike price is the price where you buy or sell options depending on how bullish or bearish you are. Time value, intrinsic value, and volatility. Volatility is how much volatile markets are. Suppose when there is a big event like a budget or a election, markets are highly volatile, the option price shoot up. And when markets are, there's no event, nothing coming up, then the option price drop. So that makes it. Then what we saw is a call. Let's go to the main part of this. This is the main metrics. You are a buyer of a call when you are bullish. When you are a buyer of a put when you are bearish. You are a seller of a call when you are not bullish. And you are a seller of a put when you are not bearish. So let's take in RSI sense. Buy call, RSI above 60. Buy put, RSI below 40. Sell call, RSI resistance at 60, not going up. Sell put, RSI support at 40, not going down. Make sense? That's the easiest way to remember. Strike price is predetermined price by the market. Different strike price will have different at the money, in the money, out of the money. So that's recap. Calls, current market price at the money, above the market price is out of the money, and below the market price is in the money. Put, current market price at the money, below the market price is out of the money, above the market price is in the money. Then that's the matrix. Then we talk about premium, intrinsic plus time. Intrinsic is only in the money, and time value is only at the money and out of the money options. So that's where it makes. Calls at the money and out of the money only time value, and in the money time value is plus intrinsic value equals premium. And puts are in the money, at the money is only time value, out of the money is only time value, but in the money is time value plus intrinsic value. And major components of the option price is price of underlying, strike price, implied volatility, expiry, short-term rate of interest. So this is where it changes the option price depending on the market. Now I think this will set you up with basics of option, and as I said that just go and check some of the option prices in the market live and see 5 strike prices up, 5 strike prices down, and then see how it behaves in the next few days, and then you'll get used to it. Ideally, if you are not used to trading option, don't sell options in the beginning, because that's risky in terms of if you don't know how to trade them. Ideally, you should be buyer of an option where the risk is very limited to the amount of premium which you have paid, and if it doesn't work out, that's the most maximum you can lose, right? So do some paper trades. This is just the basic, just to get used to it. Some of the most simple strategies which I have designed in the last so many years, and working fantastic, and people are making crazy money and making a lot. And it's very simple, like you don't need to understand those Greeks. Now if you come across any options book, you'll look at something called as Greeks, like delta, gamma, theta and all that. We don't even mention that in our program, so that's not required. Very simple, simplicity is the key. So I hope you enjoyed this video, and see you soon at the next video or the next live event. Thank you.